Morning, everybody, and welcome to today's episode of Derek Invest. I'm your host, Derek Miller. What are we going to talk about today? We're going to talk about market updates. I know NVDA is reporting earnings after hours. We covered NVDA yesterday. I think it has like a run up pre-market, and I definitely have a down move in price forecast from yesterday. I didn't even really, honestly, I did not realize NVIDIA was reporting. That information doesn't really interest me. I just look for the same. I just look for institutional money and institutional footprints and what they're doing, and then I follow suit. So what we're going to talk about today are some stocks we meant to hit yesterday we didn't get to. So we'll talk about Crowd. We'll talk about Next Era Energy. I'm also going to talk about SMCI. I'm going to go through some stocks that we've gone through. I forecast, accurate forecasts. I have plenty of them. If you haven't seen my forecast, go onto my Twitter account. Where is that? Where's my Twitter here? There's my Twitter. It's not exactly quite so obvious. Derek Me 752-63605. That is in fact me. I have not changed that handle. I may do it today. I've been meaning to do it forever, and I just haven't. You can also see me, Honest Trader, on LinkedIn, and then obviously my email address, dmiller@prometheaninvesting.com. But my Twitter, I post charts every single day of what I'm doing. Usually on LinkedIn, I just post them when the forecast hits. And there's plenty there too. I also have a Facebook and Instagram and all that, but they don't seem to be as active, so I'm not active on them. If you're not interested, I'm not interested. I mean, what can I say? Okay. One final thing: the VIP mentorship starts today. There is still a couple of slots available. If you're interested, I'm sure they will be taken. I have a dozen or so people that were talking to me about it. I don't sell this thing. This isn't a pitch. When I say I don't sell it, I mean, I'm not pushing it on anybody. Look, I'm interested in people that are interested in learning the truth. And, I saw something yesterday. I'm going to put up a cool social media post about it because I really liked it. There are three separate firms that basically own 88% of the S&P 500. So when I tell you that there is someone in control of supply of the stocks or supply of the markets, if you don't believe that, it's because you don't know anything. You don't know any better. You think that it's the guy is on there making fun of the fact that we call it a stock market or an equity market because it's three firms. Now, is that three people? No, it's three firms, I said. Right? You could probably guess who they are, but I'm not going to tell you. I'm going to put up a cool post. 88% of the S&P 500 is controlled by those three firms. 88% of the supply. And you think you can't identify what they're doing? It's just funny. It just happened to come across my desk yesterday. I haven't verified the information, but I can tell you I've been doing this for 25 years. That sounds right. That's kind of how I base my life. Sounds right. Is it 88%? Is it 78%? Is it 70%? Is it 95%? I don't know. But that sounds right. There are a very few number of people doing a lot of the moving of stock, which obviously affects the price as long as demand remains constant, and it seems to. Demand is either very high or it's high. And it's been that way for 40 years, right? I mean, it's just the way it is. Anyway, so VIP mentorship starts today. If you are interested and not yet in, email me at dmiller@prometheaninvesting.com. Email, phone number, name. I'll have a quick call with you just to make sure that the mentorship program will meet your needs and meet your goals. I believe it will, especially if you're watching this. In any case, I also do one-on-one sessions. I have 3 students at the moment doing one-on-one coaching sessions with me. I only take 5 students at a time in my one-on-ones. We usually get together once a week. Some of my students actually like to get together 5 times a week. They break it down. If you're doing 5 sessions a week with me, I am willing to break it down to half-hour sessions instead of hours. You get notes on every session that we do together, and it will help you establish who you are as an investor and trader, and you will create an investment rule book, guidebook, whatever you want to call it, based on you, and it'll cover the 3 pillars of investing: risk management, cash management, what I say, risk management, cash management, and investment management. If you don't have said set of rules for those three things, and you don't know exactly, if I told you tomorrow, if I say the market is going to run up today 6%, you should know exactly what you're going to do coming into the close. If I say it's going to open up down tomorrow 7%, and I don't care what the news is, it's opening up 7% down tomorrow. If you don't know exactly what you're going to do, that's a mistake. Period. That's a mistake. I tell everybody the same thing. Look, if you think it is a good idea, I surf, right? And so people tell me that, they've gone on to YouTube or they've done some things, or they even watch me, right? I watch you. I planned on mimicking what you do, and you think that's going to work. That's the same thing as a surfer, such as myself. I've been training, getting into shape. I know it's El Nino, and I'm paddling into 25-foot surf. And you tell me, I'm just going to follow you in, do what you do. You think that's a good idea? Do you think you're going to live through that surf session? Because you're going to do what I'm going to do, you think you're going to live? No, you're not. And in investing and in trading, you think you're going to do what I'm going to do, and that's going to protect you and you'll be able to do it? No. And that analogy is completely accurate. In fact, some would say they'd rather be dead than financially dead, because financially dead is a lot harder than dead. It just is. It's miserable. And everybody's been there. So you should know that. And if you haven't been there, good for you. Yeah, I mean, really, I'm not joking. That's amazing. And there are plenty of people that haven't been there. Good for them. But you don't take chances like that. You don't take chances like that with your financial life. You work too damn hard. You're going to paddle out in a 25-foot surf with me, duck dive when I duck dive, take off when I take off, paddle when I paddle. You probably don't even know how to paddle, let alone duck dive. What do you think is going to happen to you in a market with a bunch of guys that are experts? You're out there with the pros, just trying to follow them. It's not going to work. So anyway, that's my opinion. Do what you will with that information. Let's get into some stocks, everybody, because I'm excited. I don't know. I'm not really, I'm always excited. I enjoy doing this. But let's go down. But I'm exaggerating right there. Let's go take a look. Screen share. Here we go. I'm going to start doing some I'm going to start doing some futures broadcasts too. The only thing is, we're not open yet, everybody. The only thing is, I am most certainly not going to sit there and show you support and resistance and Fibonacci. What you're learning, and you may or may not know this, what I'm Miyagiing you with when we go through all of these stocks that I show you, this is exactly how the futures market moves. This is the exact way it moves. This is how it moves. In fact, you can use the markets against the futures markets and vice versa. So it's going to be interesting teaching that. But if you can't do this, if you can't forecast the stock market, if you don't understand the rules associated with trading in the stock market, which that in the surfing analogy, this is 5-foot waves. You still better know what you're doing, but probably not life or death. You have a lot of time in the stock market to make mistakes and fix them. In the futures market, you have seconds. So if you can't do this, I am teaching you, believe it or not, you're actually learning about the futures market every day you're tuning in. But if you can't do this, if you can't do this instinctually, and this is where the one-on-one coaching comes in, then you're not ready for futures. You're just going to go over there and get beat up. While the market stays in trend, you'll make money and think you know what you're doing. As soon as that trend reverses, you're done. You'll give it all back and then some. Okay, look at this. That's NextEra Energy. Ooh, baby. Look at that. What's that? That's one of those three firms right there. At the lowest price after the market has completely declined. So you've gone from 95 to 45. So effectively a 50% drop in price. A 50% drop in price leads to extremely high trading activity equals buying. Now, I'm going to take a picture of this. This is a good lesson to learn. We are here to learn, everybody. I always give price targets and target dates as proof of concept. I want that to be very clear. Don't swim out into 25-foot surf just because you're following me, unless you have a death wish. So, let's move in on this. This should have been as obvious as the day is long. I mean, it's matching 2020's activity. That should have been as obvious as the day is long. If it was not obvious to you, I'm not sure that you should be trading or investing. And I mean that. I absolutely mean that. Okay, here we are. So there's your volume, price run up. Let's take a look. Let's zoom in a little more. We're on a weekly. Let's go to a daily. There's a lot of people out there that think or that price over time, price always goes up. Do not come into this world with that mentality. Do you know what guys like Warren Buffett say about people that say that they use asset allocation? Asset allocation is for those who don't know what they're doing. Price drop, you're looking to generate fear. It worked. You got a ton of volume here. Then you had a price rise. What'd you do? You gapped it down again. I mean, this is a gap fills. Gap fills. They are hunting for supply at the bottom of a range. Now, if these high points in the range, like right there and like right there, if you were seeing excessive volume at those levels, that is a problem. But it looks as though next day trying to build up the momentum to break previous high price right there. Keep zooming in. Where's this? Where's that lie? Starting to, and here is selling, and this is on a more near term, right? Run a that's not keep it moving. Filled. Here's a gap filled. Zoom in a little more. Yeah, this mainly 63 cents from where it is. It's less than 1%, so not worth the play before it rallies. That's a positive outlook. There's no, let me go back and see if there's a price target you can pull. Let's go back to a weekly. Yeah, it's going to break through that high. I mean, you're probably you're coming back to your 92 area, I would say, without a doubt. Right now, I don't think it has the energy. You may get a pullback. It looks like you will, in fact, get a pullback before it'll try to breach that price, unless institutions gap through that high, which that's possible too. They'll gap through high prices sometimes to simply build up that, so it creates false energy. That will create market sentiment, emotions, right? So we talk about this all the time. The market has structure, and there are mechanics within that structure. However, that is not actually how the market moves. The market actually moves based on price movements used to stimulate retail reaction. So if I'm an institution, I want to buy more, and I want to scare everyone out. So we're sitting near a high price. I want to buy more. I want to drop price very quickly, create fear very quickly. You'll shake out the weakest hands very fast. Dump it 5% in a couple of days. Weak hands they'll fall. Do that, especially in an up market. Do that in an up market. They'll be selling that stock so fast you won't know what to do. Then they get to swoop up, right? Now, if you're at a high price, but you don't have the actual momentum to carry through that price, you can gap through it, which will create that FOMO, fear of missing out. They'll say, oh my gosh, we've now breached, for example, on NextEra Energy, we've breached $80. We're sitting at 83, 84, and it's heading to the highs, and I'm not in on it. So you'll get a lot of FOMO there. So that could be another play. I mean, that's another way it could get there. Right now, it definitely needs more energy before it breaches. How that energy comes to pass, well, we'll see. But I would say that's where you're headed. Weekly, let's see. $200, $266. Right. I love hearing how August 5th was like a mistake. I love that. Well, this happened or that happened, blah, 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 blah. No, we pulled off highs. We cranked off highs. So we had fallen 10% in the NASDAQ. And then once we're down 10%, they gap down the index 5.5%. If you could not identify that that was a move geared towards generating fear so they could buy it all, you got to do one-on-one coaching sessions with me or join the mentorship. But the one-on-ones, you'll never get beaten by something like that again. You'd have been in there buying everything. So on crowd, here you sit. I mean, this is ultimately where you're headed. We are on a daily chart right now. So that's where we're headed, which is like 333. Let's see how quickly we think we can get there. But that is where you're going. So remember, folks, when you gap down like this on high volume and you have price follow through, it takes time to get back there. It takes a lot of time to get back. If it would have gapped down like this, and even if it would have had high volume, but it automatically rebounded in price a bit, like there wasn't that, like this level of follow through from 320 down to 200. I mean, this is a massive levels of follow through in price. It takes time to get back there. So let's zoom in and see how long we think it'll be before crowd returns to 333, because that is where it's headed. I don't care what they said about a cyber attack. That's news. News is created to generate FOMO or fear. Crowd's headed back to 333. What's this low here? 336, whatever it is. Yeah, just call it 333 so you're playing it safe. Don't be greedy. Let's see how long it looks like it's going to take. So you went from 200 to 266, and you have another $70 to go. What's volume like? We want to look at volume on a longer scale than this. Let's take a look real quick at volume. Right now, we're still okay. So it certainly has momentum at the moment, even though when I zoom into this 1 hour chart, it doesn't appear so. It does. It's still. All right, nothing here on the 30-minute. Let's zoom into the 15-minute. What we're looking for are gaps, big points of volume, like large levels of trading activity at highs like this right here, which created the second back down, because the effort is being made to build up momentum to get it back to that 333. Take a little bit of time. They're going to have to raise price and then dump price so that they can buy up more supply. This morning, as you can see, previous purchasing, you are looking at it on a 4 hour. I think you can see it on a 4, and I think you can see it on a 1. You're probably right here. The reality is you're moving up this $70. Let's put this back up. You're coming back here. Let's drop that back to 28. 8/28, 2024. We are looking at crowd. You're looking at what I say 333, just to be conservative. It should hit that 339 or 336 or whatever it is, but I never get greedy. I am always conservative. With a price target, you're on a 4 hour. It's gonna take a little bit. So I'm actually gonna give this last $70. What did it take from here to here? This is that's the 5th, right? Go back. That's the 5th, and we today are at the 28th. So we're like 3 weeks out. We rallied 60, we get 70. It'll be a longer push to come through that. So call it a month. So you're looking towards year end here. Yeah, you're looking towards year end. So I'm just going to put target date 12/31/2024. Now, a lot of guys will tell you, you can't forecast out like that. I'm in options and futures, and you can't do that. Oh, yes, you can. And if you can't do this and you're playing in those markets, that's a big problem. That is a big problem because this stuff helps you to identify where those markets are headed before they're headed there. Because as you break down stocks and you're looking out, towards year end, and so let's just say, hold on, I'm going to stop sharing for a second and talk. Let's just say that we're looking out and we're going through all these stocks in the NASDAQ. And every single one of these stocks is set up for a price rise. You're looking at an hour-long chart. You're looking back and you're saying they're all set up for price increases. All of them, right? You look at the NASDAQ, maybe trading activity is not as heavy. It looks weak. The Dow's pulling down, whatever's going on, right? But those stocks, those positions are telling you where that index is headed by year end. Now, if the index is headed north by year end because you've gone through and you've seen 50 stocks all identifying the exact same scenarios, where are the futures market headed? So while someone can be screaming downtrend or the Ukrainian war started or look, we have a cyber attack, look what happened to crowd, and you're getting scared, so you're selling into those markets. If you're intelligent, well, we're headed here. So all the news, any news that comes out that's contrary to that target based on 50 of the largest positions in that index, it's a buying opportunity. And you know that because you know where you're headed. This is one way to identify trend changes before they actually happen, because the reverse can also be true. You're going through and everything is pointing down. Everything's looking down. You're poised for a down move. Now, if it's far out, you're on a 1 hour chart, a 4 hour chart, or a daily chart, and you're in the middle of a bull market, I'm not telling you that every time bad news comes out, that's the real thing. What I would tell you is look for pure elation, because that is where the selling is going to happen. That is where the trend change is going to happen. That is where trading activity is going to hit high levels at high prices. You can use this stuff, and you should be. And if they're directly correlated, you can use this market to look at those markets. The same with oil, gold, all commodities, all currencies. This stuff all works together, and it all signals each other. But if you don't know how to look for institutional footprints and then how to use those footprints, you're never going to be able to transcend out of the S&P 500 or the NASDAQ or the Dow or whatever these people say they specialize. I specialize in oil. I have news for you. You should be able to specialize in everything. No matter what anyone tells you, I am telling you. You should be able to specialize in everything. Now, is there a such thing as like reading the tape and being in tune with the tape? There is. There certainly is, right? So, but you should be able to take your knowledge and move into any market you want. Maybe you have to sit there for 2 days and just get the feel of the flow. Then that's all it would take you. But then you're trading whatever the heck you want. That's what I teach people. Okay, let's get back to it. I wanted to break away because a lot of times people don't understand, like, the stock market, while the futures market is leading the stock market, it's also not. All right. The futures market is the mechanics of the futures market are part of the foundational structure, if you will, of the stock market. The guys that are down there doing huge future stuff are market makers. So they're part of the foundation. So these guys have to make money every single day by literally getting their risk as close to zero as possible. So when you're watching a futures market, if you think it's going to signal to you what's going to happen in December, you're dead wrong. Even options, to a degree, maybe, but you have an August 5th, they're blown out. But you know what isn't? Stocks, because they move slower. They're the Titanic. All 401ks, pension funds, IRAs are invested in this stuff. Trying to move the stock market is like moving the Titanic. Whoa. Moving the futures market is like, wow, 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 you're in a speedboat. But the stock market's great for navigation. I hope you know how to use that if you're working in the futures market or the options market. I hope you do. Let's get back to it. Let's take a look at some more stuff. What are we going to look at here? We're going to go to SMCI and AI. Gosh, I remember when I covered this a few months ago and I said, this thing is a dog. You can't go parabolic like this, folks. And if you do, you're going to pay. It's just a semiconductor. This is my point about, wait, let me make this point. This is my point about market sentiment, structure, and mechanics. There's structure here and there's mechanics here, but the fact of the matter is this is market sentiment. This is FOMO. This is institutional money generating FOMO by driving price. And how do you identify it? Right there. If you think that that wasn't as obvious as the sun rising in the morning, and it is as obvious as the sun rising in the morning, and then you sit at these high prices for 6 months, come on. It's going to come back from whence it came right here. This breakout at least with just 353. You're almost $100 away from there now. And that's where you're going. At least. It could come all the way back into this base. And the fact of the matter is, I don't know anything about this company, but odds are it comes back down to $100. But if it's legit and it really is involved, it can very easily come back to 300, somewhere between 300 and 350. That's long term. I'm looking at a weekly chart. Let's zoom in. But if you bought this and think you got, oh, I got skunked, I got unlucky. No, you didn't. This is a lack of knowledge if you're buying into this thing at those prices. I covered this just a few months ago, basically telling you the same thing before the price drop even happened. To be fair, I haven't been watching this that closely. I saw it in this range, I think, and I think I used this as an example of volume at high prices within a range being selling and that this was going to dump. I should go back. I'll go back and look it up. Is there anything here? Well, this gap's interesting. Remember, as prices fall, see these gaps here? They're filling though. Zoom in. Look. Yeah, these are small gaps though. This is an individual position. Remember, individual positions are not as reliable when it comes to gaps being price targets as you have to remember that. I'm going to have to zoom in if we're ever going to see. Look at that. You can't even barely differentiate the price or the volume. Look at that. It's down 20% today. That's funny. I didn't know this. Talking about gaps filling, right? That's why this gap filled, because they're driving price down. I didn't even realize price was down $100 today. I swear to you, I didn't. I could just tell that this thing was due to dump, but you have to see something. This is a huge gap. Huge, huge, huge. But it's on huge volume. If there's follow, okay. Hello. So if there's follow through, gosh, that, you still can't see it, huh? All right. There we go. Now, if there is As you can see, this is your volume bar on a 4-hour chart. Now, the market hasn't been open for 4 hours, guys. This is going to be a monster volume bar here today. If there's monster volume here, which there will be, it should probably exceed everything on this chart. It should probably be somewhere around here by the time 4 hours are up, right? We're only 20 minutes into the trading day, and it's already amongst the higher bars on this chart. So it's probably going to finish somewhere up in here. But if there's price follow through on high volume, this 500 mark is going to take time to fill, okay? But there's not price follow through on screaming high. Gap will fill quickly. I honestly cannot make a price determination right now. It will zoom in a bit and give you an idea of what, but I do not base my opinions on what I think. I base my opinions on what I know and the rules that I follow. And the rules that I follow mean I can't give you a price target on this yet because I have not seen how the volume will follow through on this particular day. Yeah, there's nothing to be said here. What's it say so far? I have to be able to differentiate this price and this volume, and I literally can't zoom in enough to do that. Hold on, let me see what I can do here. Dag nabbit. What the heck did I hit? Bump something. Doesn't matter. I'll just fix it, but right, let's really zoom in. Let's see. Sorry for my head down like this. Let's see. That's screaming volume down, down, down. That caught some down. Looks like it's trying to catch it again. Let's go to 1 minute. Okay, here we go. Let's see. So we started at what? What's the high there? We started at 487. So we've fallen $50. We've fallen 10%. It's roaring down. Is it being caught? We'll check back on this before I end this broadcast. Right now, there's not enough because what you're either going to be looking at here, what the goal here would be, it would be to generate a massive amount of fear. Like, for example, if you close somewhere up towards 460, okay, if this were to close somewhere up towards 460, this gap will fill rapidly. If it closes somewhere down near where it is right now, you're probably looking at it's going to be a while. All right, we'll check back in on this one. We'll check back in. That's so funny that I was talking about this SMCI and then this happened. That's amazing. Makes me laugh. This again, it's just one of those things where even though I know what's going to happen, and I swear to you, I didn't look right. I didn't see that. Even though I know what's going to happen, you still go, wow. Like it's funny watching it happen in real time. So, for example, we were just talking about what SMCI looked like and how it went parabolic, which means straight up, and how it had to come back to its previous high, something like that, or maybe even like that. What do you think is going to happen with NVDA, right? What do you think is going to happen there? Is it at its peak price yet? Well, here's Tesla, and let me show you what it would have looked like before. That's what it would have looked like. Where did it go? Where did it come back to? Fell 75%, everybody. This is Tesla. Do you think Tesla or NVIDIA makes more stuff? All right. So there you have it. As you can see, Tesla sat up here for 4 or 5 months before it fell 75%. So there's your NVIDIA. I don't need to look at NVIDIA. We're going to come back to SMCI. What was the other stock I said? What did I say we were going to look at next? Oh, AI. Let's go to AI. Yeah, obviously. So this isn't even institutional hands. They just pumped it. So I'm not looking at this. I don't want to lead anybody down the wrong street. So we have play SQM. Let's see, play and SQM. Let's go back to play. We had a great forecast on this. Play, let's see where we're at now. We're going to zoom in a little bit. So the base of the range. Trading activity is telling us nothing at the moment. It did exactly what I said, which was hit 52 and then just absolutely tank. That was just a couple of months ago. Let's see if anything's changed. How far down should it go? See how there's a gap here on screaming high trading activity with a ton of price follow through? Like I said, it'll take time to fill that gap. Now, with this particular position, let's see, the gaps tend to fill. Well, you have a gap here. You have a gap. Yeah, they do actually. So you're probably like right now, this is a decent price target for it, 35. Let's zoom in a little bit. Here it is on a 30-minute chart. You have a gap down, gap filled. You have a gap down, gap filled. Yeah, you're looking at 35 here. Duck just landed in my pool. That's hilarious. 35. Boop, boop. Let's go right there. So you got 35. You're probably, we're on a 30-minute chart, guys. So you're looking at, I mean, you're probably looking at a month there, I would say. So it's 8, 28, 24. If you don't know how to choose target dates, that is something I do in my mentorship program. And that is also something that we focus on heavily in the one-on-one coaching. All right, there we go. And target date. Yeah, we're going to go to 10-1. I'm going to zoom in on this too. There might be a shorter term date on here that could be fun as well. What I like is I like to pick up positions that I can go long and short in simultaneously. And you can say, hell, it looks like it'll go here first, looks like it'll go there first. Even if you're wrong, you're not wrong, and that's why I like it. It's the greatest way to reduce risk is to find a position that you can see two price targets on, both in different directions, and then you can build into each position. Yeah, I mean, up your first stop's probably somewhere in here at 32.50, right? So you should achieve. Whoops. You should achieve 32.50 inside of what, 3 days or so? Yeah. 8/28, 2024. Now this happens to be in the same direction, right? I don't control that. But this is a good short-term play. %3, couple days. Why not? I think I have to go to the third. I think the second is Labor Day. I think. All right, there we go. Remove 5. Let me see where we're at on time here. That's 40 minutes. Let's do one more. We'll do one more, and then I'll do more tomorrow. SQM. SQM. All truth be told, I could sit here and do this all day, but I don't want to bore people. Looking over. Yeah, we had a great forecast on this before. It doesn't look like anything has changed. Hit target, hit price. Look, if you wonder or question the accuracy of what I do, head over to my Twitter. That'll solve that real fast. You can feel free to go through my lives as well. But I put a lot of charts up that are very defined. I define every forecast I make for a reason. I define it as proof of concept. I am not one of those people that regurgitates news that's been said 500 times. I am not one of those people that is vague about what he does. I don't do that. People that do that because they don't know what they're doing. They make a lot of excuses for not knowing what they're doing too. The truth is, they can't afford to put prices and target dates and target prices. They absolutely can't afford to do that. Why? Because they're rarely correct. They have no idea. You can listen. Trust me when I tell you, you can work in finance for 25 years. Because there's so many kind of like little niche things that people do, and they understand their little niche things, but a lot of times their little niche does not translate into making money in the real market. It translates into making money for their company. Their company does some job inside the market. They do something, right? And then you know how to help that company make money. But when it comes to understanding market direction or what's going to happen or anything like that, these guys are as clueless as a high school kid. They have no idea. They just knew how to do their job. What I do is learn from, dude, look, you can say it any way you'd like to say it. I got it out the mud. I created it. I had no information. I didn't have anything. I had a chart. I became a financial advisor. I realized it was a farce, that they didn't have any idea how investments worked, how the market worked. To me, that is not satisfactory. Asset allocation seems like something to me a third grader should be doing. I don't understand why someone makes a lot of money and charges you a lot of money for asset allocation. That should be worth a nickel. Not even that, actually. It hinders you. You'd be better off opening a Schwab account and buying SPY and going to bed. Why would you pay someone all that money to do nothing for you? Oh, they created a budget for me. No, they didn't. You know they didn't. They don't create financial plans for you. You know that. Don't lie to yourself. You're getting the most basic of estate planning at most of these places. There's one or two guys that have an idea of what they're doing. They're good at it. Most of the time, it's an insurance agent, and they just, it's because you fund estate plans with insurance products, so it makes a heck of a lot of sense. Anyway, I'm not trying to knock anybody. That's just how I got started. I was in that industry for 15 years. I was a black sheep. I never did asset allocation. I didn't believe in it. The day I walked away, which was roughly around 15 years after the time I started in that business as a financial advisor, I still have my very first client. And every single client was emailing me and texting me and asking me not to leave, but I was done. It got so regulated that you couldn't even make your clients money anymore without having someone breathing down in your neck and busting your hump every single day. So I left. In any case, that's a fact. You have an advisor and you're watching this and you think that I don't know what you think you're paying for, but if you like the NASDAQ, go buy QQQ. If you like the SPI, go buy SPY. Or if you like the S&P 500, go buy SPY. Dollar cost average into that thing every single month, meaning put money into it every single month. You'll do far better than you ever will with that advisor anyway. And if you really want to learn how to make money and how to be active and not spend your life doing it, contact me. All right, one final time. Mentorship starts today. I'm not going to drill that home anymore. You have until just after market close to get yourself signed up. Email dmiller@prometheaninvesting.com. Reach out, name, phone number, email, and one-on-one coaching. You can email me as well, dmiller@prometheaninvesting.com, or you can always head over to prometheaninvesting.com and fill out the contact form, and I will get back with you, and we can get you started. In any case, it's a great pleasure doing this with you. I hope you enjoy it as much as I enjoy doing this, and I really do enjoy doing this. If you're not following me on Twitter, you should be, just because there's so much information that I put up there. It's Derek Me 752-63605. Do that. Get over there. Follow me on Twitter. I put up on LinkedIn, but not nearly as much. But I do put it quite a bit up there. It's just honest trader. You'll see that it's me. On both of those, you'll see that it's me. On Twitter, there's a blue check mark, and I actually pay for that check mark so people know that it's me and that I show my ID. LinkedIn, you can't verify, but you'll see. It's me. Okay, that is it for me today. Hey, remember something, everybody. If you're not good up here, you're not good anywhere. Get outside, go for a walk, see the sunshine, do some martial arts, right? Anything, okay? Sometimes you have to fake it till you make it. Throw a smile on, right? Smile, baby. Smile like an idiot for an hour. You'll feel better. Turn a song on. Do something. Do something to break that brain out, man. These brains can be a weapon formed against us, I tell you. And you can't let that happen to you. You know why? Because you're batting 1,000. You're a winner. How do I know that? You're still here. You've never lost. You're in the fight. And that's what life is. That's what life is. So don't let this beat you. This is full of shit most of the time. You're right. You're batting 1,000. You're winning. You've never lost. Is that inspirational? And listen, if you need someone to talk to, and I mean this very seriously, and you have no one to talk to, you call me. You fill out that contact form, and I don't care what you write on there. I will get back with you. Put something in the notes. I will reach out to you. You don't have to sit there alone. A lot of you guys out there, specifically men, you think you do. You know, you don't. Look, we care, man. The world tells us that we're this and we're that, and we're not supposed to this, we're not supposed to that. Yeah, right. You're a human being, my friend. You don't have to stuff that down so you have a heart attack at 52 and die like a real man. That was Bill Burr. I stole it. Look, everyone knows I stole that. All right. Hey. Good morning, everyone. Welcome to today's episode of Derek Invests. I'm your host, Derek Miller. Welcome. So, as promised, the first thing we're going to do today is we are going to take a look at SMCI. As I said yesterday, we had to see how yesterday played out before we could have an accurate forecast for in any reasonable price and time target on SMCI. It gapped down so badly, we had to see yesterday's action to figure out how quickly that enormous gap would fill. So we're going to take a look at that this morning first. The second thing we're going to take a look at is NVDA. Everybody's interested in the fact that the earnings came out yesterday. Let's see what else. Oh, VIP mentorship started yesterday, so that is now closed. If you are interested, if you are interested in one-on-one coaching, you can email me at dmiller@prometheaninvesting.com. Also, finally changed that Twitter handle. It took all of 30 seconds. I just didn't see it as that important, but someone mentioned me yesterday. Derek, it kind of looks like it's a bot, so you should change that. Even though that is your one and only channel, you should change it. So I did. So it's at Derek Invests for Twitter. So any of you who want to follow me on Twitter, any of you that would like to follow me on Twitter, it's at Derek Invests. I kept it pretty simple. Yeah, so one-on-one coaching. When you email me, by the way, make sure that you're emailing me your name. I'll have your email address, obviously you're emailing me, but I'll need your phone number as well. And then I'll send you a link. We can jump on a call. I can learn a little bit about you, what you're trying to do, what you're trying to accomplish. And then we can go over some payment options and what you're looking to do. And yeah, we'll go from there. But mentorship is finito. We started yesterday. Okay, let's hide that again. And what else? Okay, so I'm not gonna beat on this every single day, but when we go through all of this, I want you all to understand something. When you try to track this, I've had people say this to me, and this is probably going to be the last time I'm going to bring this up, but People ask me if they can simply track what I'm doing, if they can just buy what I say to buy, and then, whether they're using options or whatever they're doing, and then sell when I say to sell, because I have target dates or I have target prices or whatever. Listen to me and listen closely. Listen, hear this. I know that everyone out there is an expert and they're telling you that that is a good way to do things. You're following someone like me. I've been doing this for 25 years. You can take a look at my accuracy on my forecast. I have nothing to hide. It goes up every day on Twitter. It's extremely high. It's because I know what I'm doing, but just blindly following me is going to leave you a victim to your own emotions every single time. I want you to hear what I'm telling you. The market works like this. The market's a business. That business has a structure, yes. Within that structure, there are mechanics, yes. Those mechanics elicit emotional responses from not just institutions, but also from retail. Retail probably being the most important, because that's the more knowledgeable hands taking money from the less knowledgeable hands. If you are the less knowledgeable hands, meaning you think you're going to follow someone to make money, you are going to lose your money. I can tell you exactly what to do and when to do it, but it won't matter. You will mess that up. You have to get educated on this. I have a system that I utilize, right? And for me, it's all instinctual at this point. It's all intuitive. I've been doing it for 25 years, but it's based on the 3 pillars of investing: risk management, cash management, and investment management. And these 3 things vary for every single person to some degree. No one is exactly like someone else in doing the exact same things. You have to establish an investment rule book. It is a rule book. It's not a guidebook. It's a rule book that tells you exactly what to do when X happens, exactly what to do when Y happens, and exactly what to do if you're sitting in the middle of X and Y. Okay? That way your emotions never control you and take advantage of you. I can't stress this enough. All right? The perfect example is from 1990 to 1999, the S&P 500 returned roughly 11% per year. The average investor, the average person, averaged 1.2% per year. The reason for that is they bought and sold at exactly the wrong times in one of the easiest bull markets to make money in. Why? Because you can get caught up in your emotions. Not can, you will get caught up in your emotions. For you people out there asking me that you want to learn to trade futures, which is where I spend most of my personal time. Listen to me. The stock market, if you can learn to forecast the stock market, if you can learn how to move in a stock market, which moves much slower and easier than the futures market. If you can learn that first, the futures market will actually be far easier for you. Reason being, when you make a mistake in the stock market, you have to wait weeks, sometimes months to fix it. Meaning you bought in at the wrong time. The stock market moves real slow, and you have to wait day after day, week after week. And finally, it hits that point where you go, oh, I get to add to this position. Now, to me, it feels slow. It's like watching grass grow, but it teaches you patience. Once you can do that, when things speed up, you'll actually find relief in that. You're like, oh my God, I bought the wrong time. Literally 30 minutes later, you're correcting that mistake instead of months later. But if you can sit through months, sitting through 30 minutes is easy. The real problem is if you don't know how to forecast the stock market, or you think they're not completely interrelated, the stock market and the futures market, well, you're dead wrong. They are. And you can use each of them to forecast the other. I know that probably doesn't make sense to you, but you can. I do it every single day. Anyway, let's get started. SMCI, we're rolling. I'm rambling here. I'm sorry. I'm sorry. I'm not sorry. I'm not sorry. All right, hold on. Let's go. Let's take a look at this thing. SMCI. I saw where it closed. I don't know the lows of yesterday. I'm just going to zoom in on this right away because what we were discussing yesterday and what I said I would touch on today was effectively whether yesterday I told you I could not tell you whether this gap would fill quickly or slowly until I saw the close of yesterday. What's the low of yesterday? The low is 395, and then it closed out yesterday at like 443. And what did the gap open at? The gap opened at 485. Oh, wow. So, okay, this gap in relative terms should fill quickly. All right, just how quickly? Well, let's take a look. First thing we want to do, everyone, is we want to say, why are we saying the gap will fill quickly? All right, there's a lot of rules on gaps. So one of the primary rules, I'm going to zoom out. I want to show you something. One of the primary rules about a gap is if you have a gap like this, and remember, I'm here to teach. I'm not just here to give you the answers, right? I can't teach you algebra if I'm not doing algebra, but I am not just here to say, do this, do that, blah, blah, blah. It doesn't work that way. So this gap here was right there. All right, so it gapped down. Now, what you're looking for is large volume, which there is. If you ignore yesterday, this is the largest volume on this chart, okay? And this chart goes from the 15th to the 29th. So it's not like a small number of days, and it's an hourly chart. Now, what you want to know is how much follow through in price there was. So if you gap down and price follows through and continues, that gap will take a long time to fill. If price falls, it pretty much reverses, which it did in this case. There was no follow through. It will fill very quickly. In this case, you're looking at like 613, 615, whatever, to 545. It took, where's your gap down? It took the 7th. Okay, the 7th was the gap. I didn't know if it was the 7th or the 6th. The 7th is the gap. 8th. All right, let's see what days that is. 1, 2, 3, 4, 5. So the gap occurred. It took 6 days. 6 days to fill a gap from 6 whatever I said, 13 to the high of 546. I mean, that's a big gap. That's a $65 gap. Yesterday we had a screaming gap, like a plummet, right? Got annihilated, down 20% at one point. Okay, now let's zoom in on this thing and see how quickly we think it should fill. So that one took about 6 days to fill. It didn't have nearly the volume of yesterday. And you can see right now we're at 457. We started gap down, what I say, 487? High 487, yeah. We started gap down at 487 from 545, okay? Monstrous volume, no price follow through whatsoever, which means this should fill quickly. So let's go ahead. What's next Friday? Is next Friday what is next Friday? I thought it was the 4th, but I've had that dead wrong all week. So some of my forecasts are going to be off because I thought the 4th was Friday. But the 1st is what? Sunday. 2nd's Monday. 3rd Tuesday. 4th Wednesday. 5th, 6th. So this looks like it should fill by the 6th. So if we go here, just say 545. We'll go. What's today? The 29th. 2024. We'll do SMCI. 545. Okay. Target date. I mean, that should not take. What did we get yesterday? So that's 1. So the 6th, yeah. 9/6. 9/6. 2024. There we go. All right. That should do it. So that particular gap should fill pretty quickly. Why? There's massive volume, which is the institutional hands of the market. It's on a gap down, and for the day, I mean, it was quite a good day. There was probably a heck of a lot more buying yesterday than there was selling. That's for sure. How can I say that? Well, your low price was 395, and you closed out at 445. Believe me, that's significant buying. All right. So let's go back to a daily. We'll look at NVIDIA because I think they reported yesterday and everybody was talking about NVIDIA. All the talking heads, they're not, I think I'm going to start calling them talking heads, not experts. They're always giving you news that you can look up basically anywhere. All platforms supply you with the same information they're supplying you with. They're not saying anything, right? So I'm going to start calling them talking heads. But anyway, let's take a look at NVIDIA. It's only down 232. Let's see. I don't remember where it was supposed to open. Yeah, NVIDIA. It looks like NVIDIA's gap down is not like SMCI yesterday, right? Not at all. I mean, look, this right here, and I have a downside target on NVIDIA. Let me show you. Let's see where did I have that thing? I think down here at 110. Yeah, it's at 110, and I can't remember what it's there for. I can't remember the target date, but it is down there at 110, and I think it was meant to be next Friday, which is the 6th. But this gap will fill first. So if you're looking at a short-term target, which is only a couple of percent, this gap could very, very easily fill today at whatever 125. I mean, I don't even know that this is worth posting. In fact, it's really not. I mean, this gap should fill today, if not today, tomorrow. But it's not really even worth posting. That's the truth. It's really not. There's nothing exciting about that. All right, so let's see. What else do we got to look at today? Let's take a look. What else are we going to look at today? So, as promised, SMCI, NVIDIA, Dell. If you remember, Michael Dell was selling off all those shares up there, and I had a downside price, like it was a shorter term downside price at 135. It sits down to like 110 now because Michael Dell sold so many of his shares. No kidding that it came down. Oh my gosh, it was down at 90. And guess what? Guess what, everybody? What's this? What's that? You see a gap on a monthly chart and you ignore it. You're a crazy fool. Look at that. That is a gap on a monthly chart. This is a gap on a monthly chart. A gap on a monthly chart equals and guess who initiated that manipulation? Obviously, the man that sold all of his shares. Hello, Michael Dell. Nice job. Really a company you can rely on there. The odds that was not him are slim to none with the amount of shares that were sold at that high, which, by the way, go back, check out my forecast. I told you. It was the price at like 155. It was close to the top. It was up in here. And I told you I think I'll look it up and post it with this video, but it was I had a price target at 135, which is guaranteed because I saw this. And remember, I'm not always looking out super, super long term. Okay. I probably saw that on the monthly chart. That's sickening, actually. Really. Daily. Zooming in. Gaps filled. Look, there was a gap here. Guess what? It filled. Gap here. Guess what? It filled. Let's see. Let's zoom in a little bit more here. You see, this is my point, everyone. When you have the strong hands or institutional money involved in a position, these gaps will always fill because they are trying to get the highest prices on their sells. They are trying to get the lowest prices on their buys, and they are not going to pay more or less than that. Institutional money. Wait, let's put, institutional money equals gap fills. So when institutional money is at play, gaps fill because they want the highest price for their sells and they want the lowest prices for their buys, and gaps inhibit that. They are also an amazing way to elicit emotional responses. When people see that something is up 20%, breaking to new highs, they get excited. When something drops 20% to new lows, they get scared. That is the goal, my friends. Everyone telling you, oh, there's mechanics and that's happened because of this, that happened because of that. It happened because your emotions are the easiest way to manipulate you. You are a human being. Manipulating your emotions is easy. Let's zoom in. Let's see if there's anything on here that we can get a reasonable target for. There's a gap down here. They're all over the place in this chart at the moment. 132, 130. They're small though. 125 to 124 on an individual stock position is not a big deal. They do fill, but you really do look. But I'll tell you what you shouldn't like. You shouldn't like. Let's see. Let's look at the volume here. As you can see, I'm checking the high prices in this range for selling, and I'm checking the low prices in this range for buying. Because if there's a ton of selling at the high price in the range, that means institutional money is looking to drive prices lower. If most of the volume trading activity is taking place at the low points on the range, that means that institutional money is buying. This isn't, let's see, gap filled. It is filling even the smallest gaps though. Yeah, it is. Now, the beautiful thing about this particular chart is you gotta love charts that give you target prices both ways. They're amazing, right? So you have target prices here and here, which is a great thing because you can position yourself for a 125, and you can also position yourself to build from call it 104, right? So you have 104 and you have 125. Right there. And you get to build a position. You get to build a position both ways. And I'm going to explain that in 1 second. So, what do you do here? Well, depends on you, obviously. But let's talk about. So, how can I do? Can I draw arrows with this thing? Probably not. So, let's back this up. We go like this. We're going to come over here. So, what can you do about this? You have this price above you. right? You have this price below you. Well, I don't know where you'd be sitting right now, but my guess would be, knowing me, I can tell you right now where you'd be sitting. So if you're in this stock and you're looking at this, this is high volume, this is low prices. You have a gap up here at 132, 133. You would be a buyer of this particular market, of this particular position for sure. Wait, I gotta get back to 45 minutes, I think. Okay, so you would be a buyer of this position. So right now, you would know that you have 133 on top of you, and you would know, and your short term, you have 125 on top of you, and below you, you have 104. So you can either build into a long, because you say, hey, if price drops down here, I'm going to add 5% to my position. If price rallies to here, I'm going to sell off 5% of my position until I reverse back down to 104, where I'll add 10% of my position so we can ride to 133. Let me repeat that. If you are someone who goes long only, you would simply sit where you are right now. If price dropped to 104 and you were building a 10% position, you would say to yourself, I'm going to add 5% to this position. So if you have 5% here, now you have 10. As this rallies to 125, you would say to yourself, I am going to sell off 5% of my position. At that point, there would be a pullback price here that you would add 5% to your position. You ride it to 133, and at that point, you'd sell off 10% of your position. If you're somebody that goes short and long, and then conversely, if it doesn't come back down to 104, you would wait till it hits 125. You would sell off that 5% position as it pulled back. You would buy back in 5 or 10% of your position, and you would run to 133. Now, if you're somebody who goes short and long, someone like me, and I find that preferable. If it falls first, there's obviously no short to be had. Are you going to short from right here from 111 to 104? That depends on you, right? That's all. So you have risk management, cash management, and you have investment management. So one, is this a good investment for you? Does it move at a speed that you find desirable? Two, risk management. Is the risk reward from 112 and the upside's 125 and the downside's 104? Does that risk make sense for you? Well, there's two ways to evaluate that. If you're a short guy and you say, hey, listen, that leaves 7% below me, that suits my risk profile, and you're sitting in cash, how much cash are you sitting in? I tell everyone there's almost no excuse not to have 20% cash at all times, because if something catastrophic were to happen, you need to buy the farm. And you don't need, so that's kind of a golden rule, but it does vary for people. For some people, they're in 50% cash. Some people are 30, and some people, they hold zero cash at all times because they're so active that they're always creating cash every single day. It depends on you, right? This is what I try to explain to you. This is why one-on-ones are so imperative. This is why one-on-one coaching is so imperative to someone who actually wants to do this. So back to this. You could say, I'm going to add a short right here. Right now, I'm going to add a 5% short. I am 5% long. I am going to add a 5% short. When it gets down to here, I'm going to close out that short, and I'm going to add 5% to my long, thereby using no additional cash, right? So you're 5 short, you're 5 long, so you have 10% of your money invested. As the short comes down, you're going to sell the short, you're going to buy the long, you're still 10% invested. You're going to run it to 125, where you're going to sell half off, at which point you're going to add probably a 5% short, because there should most likely be a pullback from 104 to 125. That's a 20% move. There should be a pullback. You're going to add a short. You're going to do it again, because the ultimate upside target is 135. Well, you say, well, Derek, what if you're wrong? What if it doesn't go short? Well, you should be planning for that. So right here, you say, I'm going to put on a 5% short. I'm already 5% long. You say the most I want to be short is 10%. So if you're at 112 and you're going to 125, you want to build 5% more into your short position as you go to 125, which would mean if you have 5% short and you're going $12, that's roughly every $2.20, you're going to add another percent to your short. So this short, you'll be losing money, right? Because you're already 5% short at 112. But every $2.20, you are going to add another 1% to that short position until you get to right here at 125. Once that reverses, and it should, will it reverse to 104? We don't know. We'd have to evaluate at that time. But if it reverses, Then you set up a system as to where should you be covering your short. The fact of the matter is, if you're 5% short here and you build into a short all the way to 125, your average cost is probably somewhere around 117. That's probably your average cost. Maybe it's a little higher. I mean, even if it was 120, no, it would actually be lower. It'd be like 115. So even if your average cost is 115, which would be your break even, right? That's your break even on that short. And it's probably a little higher. It's probably 117. So every dollar you drop below 117, you're gaining on that short. And again, we don't know how far it'll fall. Will it fall back to 104? There's a lot. I mean, according to this, there's huge potential for that. If it doesn't go to 104 first, odds are it's going to go to 125, maybe even 133 before it pulls back to your 104. But 104 is left open, and this chart doesn't seem to like gaps being left open. So that's what happens. So you build your short. Now here you are at your long. What happens when you hit your long price? You're going to sell off that long. If it goes here, you're going to sell off that long, and now you're 0% long. As it pulls back, you are going to add into that long position. Probably at the same point, you're going to close out your short. Well, Derek, what if it goes to 133? Well, you're still going to sell out your long at 125, which leaves 5% cash available because you had a 5% long position. That 5% long position you should build into a short to 133. That will up your average price for your short. Is it going to pull back at 133? If you run from 110 to 133 and you think you're not going to see a 10% pullback, you're out of your mind. At that point, you can either close out the short and build into a long or reevaluate, and perhaps short is the play. So you can see that when you have an upside target and a downside target, you can eliminate a lot of risk, and you eliminate guesswork altogether. You don't have to guess. You understand? Because no matter what this market does, we have two price targets, one on top of us and one below us, and all we have to do is build into both. That's it. But if you don't know how to manage cash, and you don't know how to manage risk, and you don't even know if you should be in this particular investment, me giving you this, me showing you this does nothing for you. Because if you're not managing your cash correctly, you won't have cash to buy in and sell. If you're not managing your risk correctly, and you're only buying to the upside, or you're only shorting to the downside, you're adding to your risk. These are the positions I look for. And you can do this within indexes as well, but you have to learn it first, don't you? You have to learn it. All right, I'm going to take a picture of this. I'm not going to give the entire explanation. If somebody wants the explanation, they'll need to watch the live. But I hope those of you that are watching this understood what I just said. And if you have questions, email me at dmiller@Promethean Investing. Hold on one second. That was actually a really good opportunity to teach the process. And I love those opportunities. But I will tell you, I don't go into that much depth on individual positions very often. And I'll tell you why, because that is what people pay me to teach them. Okay. I give you proof of concept in all of my lives. I show you that what I do works. I show you, and I only show you one direction, because the explanation I just gave, I'm not going to give on every single position. All right. But that, let me tell you something. If you have a portfolio of positions like that, you have 10 of them, now you got it. Now you understand. You're basically carrying as close to 0% risk as humanly possible. You have accurate price targets. You're managing your cash appropriately. You're managing your risk appropriately. And you're only going to look at investments, obviously, that you would be interested in. Now, imagine you pick up an SMCI and you have price targets like that because they were there, and you come into it yesterday. That's just a golden ticket. You go, oh, amazing, because your short is going to it's going to explode like to the upside. You're going to make a ton of money when a stock does what SMCI did yesterday. And guess what? Since you realize that now with that gap at the open yesterday with a massive amount of volume, an incredible price drop that completely rallied. Now you say, oh, now we're looking to the upside. So you would go in and you would look at SMCI and you would look for some downside targets. Okay, because you need to manage the risk. Okay, how much cash do I have available? How much should I put to the long side of this thing now? How much should I put to the short side of this thing? I hope that was helpful. I know it is. Okay. That is how you manage money for yourself. And you have the ability to do it because you have an advantage that the strong hands, aka institutional money, aka smart money, whatever people call it, you have an advantage they don't have. And it's simple. The advantage is you can move very quickly, you're very nimble, and they're not. I say yesterday they're like the Titanic. That's probably a bad example. I'm not trying to say they're the Titanic and the fact that a Titanic sunk. What I'm trying to say is they're giant cruise ships. That's how they have to move. That's how they have to turn. You are a one-man, like jet-engined motorboat that's doing 360s and goofing around and flips. You're like a jet ski, but with a giant motor on it, right? You can do whatever you want. And the motor gets bigger, the more you have to invest. The motor just grows in size the more you have to invest because that gives you more opportunity. So I hope that was a great example. I'm going to leave it off there actually because that was such a great example to give. No, I'm not. I'm going to do a few more, and I'll tell you why. Because there's some people reporting earnings tomorrow, and I want to look at some of them. So let's look. I think Salesforce already reported. We'll look at Salesforce, Affirm. There's 5 below there. Cooper. Let's take a look. I'm going to look at a couple of more here. Let me close this out. There's my Twitter handle, right? There's my email address. So if you are interested in the one-on-ones and you're watching this, you should be. If you invest and you're watching this and you're serious about what you're doing, you should be doing one-on-ones with me. There are very few guys that are going to show you what I'm showing you. That's because they don't need to spend the time showing people this. They're doing it for themselves. They're managing their own money, and they're making a lot of money. Okay. No, we'll show that. We can still show that. So let's take a look at, we're going to look at Affirm and ARBK. AFRM. Oh, I'll look at Salesforce real quick. They might have reported yesterday. CRM. Oop, looks like they did report yesterday. Look at that open. Reversed immediately. Reversed immediately. Look at that. To fill that gap. You see that? That's to fill that gap, folks. That is why price went where it went this morning. Okay, daily. So we just look at the daily. Let's look at 4 hours. Boop, boop. And guess what? There's another one up there at 294. You're sitting at 260. 1 hour. Probably trying to build up momentum. Oh, it's a lot of selling. You have to take a look at where today closes, but I have to tell you, on the outset, just like looking at this, that's a lot of selling. I definitely would not. There's no reason to play in this. Anything that does this, you don't even need to look at it. Nope. This is poor risk management, folks. If you go into a position like this, you don't understand risk management. There's just no reason to get involved in something like this. No reason whatsoever. At 272, what I tell you, 294s or 293, 290, whatever it was, that's probably because this is close enough. Yeah, there's no risk management in this. I'm not going to look at this for 1 minute longer. I would never encourage anybody to be involved in this. I think to the upside, you have this, whatever it is, 290. But it hit 272, which filled this gap. So you are going to get a strong reversal. There's another gap up here at 278. I mean, look, I believe 290 is like the play. That's where it's headed. But there's just no reason to play with that one. Let's look at Affirm because there's no risk management there. None. Oh, Affirm reported, I guess. Oh, it's on a huge gap. It's up 30%. Something like Affirm up 30% on monstrous volume. I can tell you now, again, it all comes down to how does today play out. So the trading activity is there. The price is there. Is there follow through on price to a higher price? If there is follow through, then this gap is going to take a good deal of time to fill. This will probably hit 52 before this gap fills if there's follow through on today. Once again, if I try to give you a forecast on this now, I'm like the talking heads that I always judge so harshly. I'm just guessing, which is primarily what they do each day as they regurgitate news you can find anywhere. ARBK in 5. ARBK. Regurgitating news and teaching you nothing. 135. Yeah, no thank you. Let's see. 5 COO. Let's look here. 5. Oh, what's this? What's this? What's this? What's this? What's this? What's this? Oh, oh, look at that. Here we go. What's that price target? Up at 98. You're at 79. Oh, that's nice. Let me zoom in. You do have this below you, though. So here's another one. That's no problem. There we go. Whoop, 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 whoop. Yeah, that had to fill. This will probably fill too. Okay, this is another. This is another Dell sort of, and I'll tell you why. Because this is going to take a little longer to materialize. The gap build this morning, obviously, because this is all about upside. This talks about upside. 5 is about upside. Okay, but there's also downside here. So here's what's interesting about this one. So your ultimate upside is here. Your ultimate upside is 200. However, you have upside here. You have upside there, and that's your closest. Now, I'm going to have to zoom in on this a little bit. So what you want to notate here mentally is these upside targets of 200, 130, and 98. You want to recognize the fact that they exist, all right? And you want to keep this in you want to remember this, right? Because this is how you play a position. So you say, because what don't we want to do? You don't want to fight the trend of a position, but obviously none of this is going to go straight to these areas, and it's going to take quite a bit of time to do this. So what you want to do is you want to mentally notate that this exists. All right, you go, okay, this exists, but you're on a 4-hour chart. So you're looking out months here. If this can go as long as 4. This is 3 to 6 months on a 4-hour chart. Okay, a 4-hour chart, daily chart, anywhere from 6 to 18 months. That's a wide spread, right? Yeah, because it depends on when this stuff's occurring. This happens to be occurring in the fall, which means that it should be a little quicker. So we're going to mentally notate that we see a 200 up here, a 130 here, and a 98 here. Now we're going to zoom in a little bit. Because when you play a position, unless you really are that patient, like if you're genuinely just a true buy and holder that is only interested in missing huge downside, you could probably set up what you're doing with this particular position based on those numbers. And you realize, hey, this stuff's not going to materialize for up to 6 months. So I'm going to do this again today because I have the opportunity. This is 5, okay, 5 below. Doesn't really matter, to be honest with you, what it is. We're going to call this 70. I'm going to call this what? Well, I'm going to call this 98. $98. I'm going to call this $70. Okay. Now we are looking at 5. So it's 8/29/2024. I always date this stuff because I believe if you're not dating it, it's because you don't want to be held accountable for what you're doing. That's the beauty of just saying, I don't tell people what to invest in or how to invest in it. That I'm just sharing with you what I see. It's like, yeah, anyone can see that. And for those of you who don't know what I'm talking about, most of this market information can simply be bought through whatever platform you're using, right? So if you're using TradingView, for example, you can just buy any flow information you want, any order information you want. You don't have to listen to some guy explain to you, oh, look at this here and look at that there. It's right there for you to have. Now, some of you may not understand what that information is. And if you don't understand what it is, you shouldn't be using it anyway. Therefore, the information being shared with you is useless. Why would you utilize information that you don't know how to use? Which is what I am always on here talking about, even with myself as well. Using the information I'm sharing without knowing how to use it is foolishness. Okay, so here we go. We have an upside target and a downside target. What do we think? Well, naturally, it looks as though your downside target should be met first, which is $70. It's roughly 10% below where you sit right now. Okay, what's your upside target? Well, it's $98. So $98 from $78 is a little over 20%. So if you're the type of person that goes long only, and you are looking at this particular position based on this gap and the fact that we have gaps all over the place on top of us, you would be buying 5. You would own some of 5. This would be an investment you were tracking. If you're tracking this, we'll just run the same numbers again. Some people build into 20% positions, some build to 5, some build to 2. I'm just using nice, easy, even numbers so that I can explain this in a manner that everyone will understand. So here we are. We own 5% of it right now. It reached 83, 84. We didn't sell coming into earnings. God knows why, given the fact there's gaps below us, but we didn't. Again, this mistake wouldn't have been made, but we're running off what we have here. So we have 5%. We're long only. We only buy. We don't short. We don't believe in it. We only buy. So we want to build to a 10% position by 70. We have about 10% below us. So every time this thing drops $1, or whatever it is, 85 cents, we are going to buy. No, because we can only build, we own 5%. We're going to build to a 10% position. So every time this thing falls $1.70, we put another percent of our money into it, okay, to build this position. And here we have 10%. As it rallies to 98, we're going to sell off at least half of that. And and then we're going to work our way up the chart to 129, and then ultimately what I say to 200 or 198, whatever it was. Now, if we go short and we go long, right now we're going short. We're going to put a 5%. We're going to put a 5% short position on. If it drops, every time it drops $1.70. No, if it drops, we're going to ride that 5% short all the way down to 70. Then we're going to close out that short. We're going to add 5% to the long position that we own. We're going to carry it forward. Up here, we're going to sell off 5% of our long. We're going to take on 5% short. We're going to watch it drop, so on and so forth, up to 129, up to 198. Now, what if we have a short here at 5% and this thing rallies up to 98 before it falls back down to 70? Well, that's about 20. We're going to say it's 20%. 20% away from us, and we are only adding into that short 5% more, right? We're already 5% short, so we're going to add to our 5% position. We need to have 5%. That means every 2.5% we're adding a percent. So it's probably every $2, every 4. No, it'll be every 4. Yeah, let's just say every $4. Every $4 this rises, we add 1% to our short, right? And then we're probably dollar cost averaged in pretty darn low, because right now we sit at 78. So you're probably dollar cost averaged in at like what, 85, or no, it'll be higher than that. Gosh, I don't know exactly where it would be. No, 85, 87, somewhere in there. So every dollar below that, you're making money. What if you say, okay, but I don't have a short on right now, and I want to put a short on right now? Well, if you're going to the upside, you have 20% on top of you. You want to build to a 10% short. That means every $2, you add 1%. You'd add 1% now, and then every $2 that it rises, you add 1% to your short. Well, what if it falls directly? Well, then you only have a 1% short position, okay? It's that simple. As you and the buying should be very easy. You should understand that very easily because you're not going to watch. So if you own 5% here long and you're a long only, you're going to build into your 5% as it drops down to 70. So right now you're at 78. So it's not exactly $10, right? So it's like every $1.70 you're buying into that long. So you buy it, it drops $1.70, you buy 1% more. It drops $1.70, you buy 1% more. It drops something, you buy 1% more, so on and so forth. You're always building in and out of positions in both directions. This is another great example of how to control risk. Because how can you really be harmed by doing this? Can anybody tell me how you can truly be harmed? Let's just go worst case scenario. Let's say that you are someone who goes short and long, and you say right now at the open at 83, I'm going short. We are gapped up. I'm going short at 83, which wouldn't be a bad idea with these two gaps below you because you should have at least been able to get to 77.50 before this get there. It's probably pretty close now. And you should have been scaling out, right? We're not going to get into that though. So the low 78.10, it's 77.50. You knew you were safe to about 77.50. So you should have been scaling out of the short that you made this morning. But let's say that that's not what happened. You're still sitting in it. So you went 5% short here, and then all of a sudden it just started to rally, right? It rallies up and you're building into this short. Well, by the time you got here, if you put 5% in here, you're 10% short at 98. You are. Now, you're also, right? You were already 5% long here. So you're also 5% long. So you're net 5% short in your portfolio. This thing is going to pull back at least, like, even if it pulls back to 90, if it like it pulls back half of what it rallied, even if it pulls back to 95, and you say, I want out of this short, you get out of this short. What did you lose on that short? 2.5%. Now you're 5% long and it runs to 130. So now you're 10% long to 130. You lost 2.5% on your short, but you're now 10% long at what? If you bought it, if you went long here at 83 and then you went long again, say it just pulled back to 95, you're at 12. So at $89 to 130, all you did was profit. And guess what? You reduced your downside risk the entire time. That's why you took the short on. You took the short on to make money. It didn't work, but it also didn't cost you very much. If your dollar cost average into your long at 89 and it runs to 130, you made 40% on your money. You lost 2.5% on your short, and you also reduced your risk dramatically. Now, you were smart. That's a smart play, and it went completely against you. I hope that makes sense, and I hope you can see that. I'm going to end the share for the day. We had two amazing examples today with Dell and then with Five Below. Thank you so much for joining me. Remember, if you're not good up here, you're not good anywhere. All right. If you're having a tough day, you get outside in the sun, you go for a walk, smile like an idiot. Smile like an idiot for an hour. I promise you, it'll work. You could do the most miserable things in the world. And if you're laughing, we would get into CrossFit and I would be doing like my second CrossFit workout of the day. And I would just start joking. Like the pain would get so bad. I just started laughing and goofing off. Next thing you know, the whole room was like that. And we were just like hammering out. And then by the time it was over, I thought I was going to die. But I had fun and it changed my attitude. Right? Just change your attitude. Just start smiling. I don't care if it's hard to like just go like this anyway. Just do it anyway. Try it for an hour. It'll work. You'll feel better. When you feel better, better things happen. I promise you. All right. As always, I hope you guys really enjoyed that. I enjoyed doing it. I hope you like watching this as much as I like doing them. In any case, thank you so much for your time. Remember, every day above ground is a good day. Good morning, everybody, and welcome to this episode of Derek Invests. I'm your host, Derek Miller. All right, what are we going to talk about today? As usual, I am always trying to keep it interesting in what we're looking at, and I love to look at a lot of different sectors, industries, markets, you name it, because I like to prove that what I do and what I teach here and the system that I operate under transcends any individual index, any individual commodity, any individual currency, whatever the investment is. And today, what are we going to talk about? Well, it's the first month of trading in September. It's September 3rd, 2024. What is September synonymous for, everyone? Right, market crashes, markets that fall. So I thought that would be a great thing to explore this morning. So what I did was I took a look at what the two best performing sectors were during the month of September. As no shocker to myself and probably no shock to you, it was consumer staples and utilities. Why? Because they are defensive sectors. Now, how many market crashes have taken place in September? I don't know. I didn't do that research. I'm not digging into that. No, actually, ChatGPT could probably answer that very quickly. But the truth is, there's far more fake outs in September than ever seem to be reality. And what I can tell you from watching these markets every day, day in and day out, is we don't have a setup for a market crash. That's for sure. So I don't see that at all, but that is not the point. The point is consumer sentiment, consumer opinion, and market opinion. Because let's face it, most of these market experts are nothing but salesmen or media regurgitators. So that's what they're going to talk about. They're going to talk about how dangerous September can be and the setups they see for the downside. Why are they going to talk about this month? Because they have the highest probability of success in a false forecast this month. It's like remaining a bull, right? If you're a bull, you're right 80% of the time. It doesn't matter that if you stay a bull throughout the bear markets, you make no money, but you're correct 80% of the time. Just like this month, if you bet on a crash in the month of September, you have the greatest odds of success. If you bet on a market reversal in September, you have the greatest odds of success. So that's what everyone's going to talk about. I'm going to tell you that I don't see any evidence of that. But here's an interesting thing that we can do to figure out if there is anything behind that. Is this the month? Right? Okay, so we don't see anything in the indexes. The indexes have weakness, yes, and I've said that to you. And that's commonplace for September. Why do indexes have weakness coming into September? Because it's one of the easiest times to fool retail, to fool investors into believing what is coming? A crash, a big market reversal. So it's not always, a significant portion of the time we come into September with weakness. So there is weakness in the indexes. And the fact that the markets are down today is almost laughable because this is the setup. And this is where the conversation gets to start about the fear mongering of crashes in September when there's no evidence we have anything happening on. I don't see anything in indexes right now that tell me the people in charge of the market, the people that are the foundational structure of the market, have been selling their positions at any high rate of volume at all. And if they're not selling, then there's not going to be a major crash or a major sell-off. Because in 2008, you were led to believe that you couldn't see that crash coming. The fact of the matter is the market was already down 20%. We had been falling since the summer of 2007. We didn't have a crash until September of 2008. That crash was very easy to see coming. The setup for that crash was perfect. We have no setup right now. But what I want to look at is one of the two sectors that I just talked about. So I'll probably look at utilities tomorrow, but let's dig in for ourselves, right? We can't just go on these assumptions that I'm making right now. We don't just want to have an opinion on what we believe is going to happen. We need substance behind it. So I have this belief that a market isn't going to crash. Let's try to disprove me. Let's look at the top 10 consumer staples companies and see if they look like they're set up for a dramatic increase in price. Because if they are, perhaps there is a crash in store, right? I'm giving you my opinion based on what I've seen thus far. But if we take a look at consumer staples today and we take a look at utilities tomorrow, and they look like they are poised for rapid price movement upwards, that could mean that institutions didn't pull their money out. They simply were transitioning it into a defensive sector, the two defensive sectors, right? Well, there's several defensive sectors, but those are the two best performing defensive sectors for September. Therefore, for market crashes, therefore, they're the ones we want to look at. So let's take a look, all right? So what we're going to look at today is consumer staples. We are going to look at Procter & Gamble, Coca-Cola, Pepsi, Nestle, Walmart, Costco, I can't remember the others. We're going to look at the top 10. All right. So let's get started. We will take a look at Procter & Gamble, Coke, and Pepsi first. Let me share my screen with you. And remember, if we see something that looks like a massive market rise, like these stocks are poised for a big run, that can mean that there is a sector rotation occurring into those defensive sectors because it's September, which could indicate something. So here we see, oh yeah, the Nasdaq's down 1.5% coming into September. Not at all odd. Procter & Gamble. Let's take a look. So I don't think, hitting all-time highs right now. All right. So Procter & Gamble hitting highs. They're hitting highs in a meaningful way. Let's take a look. We're going to zoom into a weekly. How was everybody's Labor Day weekend? Mine was amazing. You know, I was talking with my wife this weekend about Labor Day weekend and the fact that I know it's a U.S. holiday and that it's not a holiday celebrated around the world. But I have to tell you, to me, these holidays are so important because myself, I'm an entrepreneur, right? Okay, guys, we see this rising. There's some massive volume, but it is on the breakout. So you have to imagine that this is all those, machine trading. They jumped in once the breakout existed. You see one back here too. This probably caused the breakout right here. Okay. So this probably caused your breakout. This is definitely institutional players getting involved because the trading activity is standout. This is definitely institutional trading getting involved. And institutions are relying more and more on machine trading and computer trading, which I believe will be the fall of them. I don't believe that's the way to do it, but they're trying to manage, there aren't small money managers anymore. All these guys want to manage $1 trillion in assets, even though it really inhibits what they can do for you. So you're going to see some of this. It's just becoming more and more obvious, which is amazing. So if you're watching me, you're going to learn how to spot this stuff really, really easily. Okay, so here we are. Oh, this is on a price drop. Look at that gap. Talk a lot about gaps on here, folks. If you're not familiar with what gaps are nothing more than if a price closes higher than it opens. So in the overnight, it opens lower, gap fills, it runs up. Gaps are usually used, especially in the downward. If you're at a high, which we are here, and you have a big gap down, traditionally that's used to scare weak hands, retail hands out of the market, so institutions can buy more and drive price higher, which in this case, that appears to be so. Zoom in a little bit more. Procter & Gamble does look strong. Back to the holiday weekend. I talk during these sessions. You got good volume going today as well. I talk during these sessions. I talk about different things. And the reason I brought up the holiday was because for me, those days like Labor Day, here's a gap, it fills, running up on high volume. Those are the days where I really can shut down and not think about work. And I have to tell you, it's one of the things that you have to do as an entrepreneur. I'm sure you have to do it if you're in the 9-to-5 daily grind as well. That's that 9-to-5 daily grind of having a boss and having to be there. I have very limited experience in that world. So I would bet that those days are important to you too. And it probably ever increasing at this point. Okay, so you have a lot of volume up here at a breakout at a high price. It looks to me like in the next few days, you'll need to return down here to 171. Do I think this is worth noting? I mean, I guess so. I mean, you can always note this if you're a short-term market person, like if you're looking for short-term swings, you're a day trader or a swing trader, I would say you got to come back down here before you continue that rise up. It looks to me to be that way. I'm not going to notate this particular stock because there's just not enough weakness here. So let's move on from Procter & Gamble. As I was saying, even it's probably ever increasing in that world. that you need to take those big mental days where you say, I'm not working, because unlike what technology has told us, it has us all working around the clock. It makes us available at all times. And it's, so now I imagine in those worlds, you used to work your hours, you went home, you turned your phone off. Weekends came, you turned your phone off, you did what you wanted. I would think that has been changing or has changed. That would be my guess. I don't know. Again, I have limited experience in that world, but it would appear to me that would be the case. And as an entrepreneur, I desperately need those days. So whatever your weekend, whatever your holiday is, wherever you live, whatever country you're in, make sure you take advantage of those days, whether the U.S. market is open or not. We all need those days. And I'm a big advocate for holidays, especially with my family. Let's see if Staples has this same pattern real quickly. Okay, it is on a breakout. So it makes sense that we're seeing a lot of these companies on a breakout. I'm a big advocate with my family and with other families to take the time. Like I made a vegetable tray and a fruit tray for the family yesterday, and we had some steak and hamburgers and hot dogs and hung out by the pool, and everybody came out. We had a squirt gun battle, and I'm a big advocate for that stuff. You have to do those things. I mean, do you need a holiday to do those things? No. But I'll tell you, when everyone is shut down, it really feels okay to shut down. And so even though it seems to me that the world would love to eliminate these holidays, and probably in the name of the fact that, we're moving into a global world, and those holidays sort of create some separation. But you know what? I don't care. I don't view it that way. And I think it's necessary for people. And I think holding on to your culture and holding on to who you are is not a bad thing. I think that's why we all love to travel, right? If we all just wanted to be around people that do the exact same thing as us, I don't know that we need airplanes very much. That's why we all travel. So there's nothing wrong with holding on to those things. And they only separate us if we let them. They can be pretty cool. So with Coke, I don't see a ton here either. Remember, everyone, what we're looking for is high trading activity. Why? Because the strong hands of the market, the institutional hands, use high volume to stamp their footprint. This is how you can identify. Some guy on Reddit isn't doing this. What's his name? Roaring Kitty. I guess he's trying to make a comeback as some sort of advisor. He was the head of one of the biggest pump and dumps I'd ever seen. He cost people more money than I've ever seen. I don't know why any of you are fans of this person. I don't care what he says he's for. What he was for was his pocket. It was very obvious. They want to demonize the Wolf of Wall Street, but we're supposed to celebrate Roaring Kitty. Sorry. And if you like him, oh, well, you're wrong. What he did was wrong. It was the average person that got destroyed in his little pump and dumps. It was the average person that made no money. It was him that made all the money. I don't respect people like that. He took advantage of retail. He took advantage of people that don't know as much as he knows. And is probably because he is more involved than you can imagine. And they were definitely in those particular scams. They made so much money on his back, they don't care. They don't want to catch him. If he can do that again, that's great, because they can outplay him easily. Coca-Cola sort of has the same move as Procter & Gamble, and honestly, there is no big downside here. It's definitely a breakout, but the entire sector is breaking out right now. So we do see a gap here, and as we saw, there was downside on Procter & Gamble as well. So would I say it needs to return here? Yeah. I mean, this is a consumer staple, everybody. Is this a huge move? No, it's 1% below you. So again, if you're a swing trader, probably closer to a day trader, this might interest you. I am not going to, well, you know what? I will take a picture of this one. We'll look at Pepsi next. It does look like there's been some transition into consumer staples, though. It most certainly does, because, I mean, it's breaking a new highs, going against the underlying market, its underlying index, in, relatively substantial ways. If you're breaking a new highs while the index is reversing, that's substantial in itself. Let's move on to Pepsi. Let's see if we can find something. Okay, so Pepsi's interesting. it's a laggard in these staples. And sometimes the reason you want to look at laggards is laggards will catch up to the leaders. Let's see if that appears to be the case here. No. Pepsi does not have a lot going on. Here's some gaps. As you can see, they've filled. Gaps have filled. You got a strong reversal off the high at 182. But with the sector itself looking very strong, I think it would be very reasonable to expect Pepsi to break out of this high. So exceed. You would see this high and you would expect Pepsi to have a breakout. And this does, for you swing traders and short-term traders, upside, because you would expect it to be on that level. Also look like weakness in Coke and Pepsi. We didn't look at the staples as a sector. Oof, that's a lot of volume. That's a lot of activity, everybody. That looks like it's going to move. Let's see. Look at that. Look at it approaching that 177. Wow. Look at. I mean, you can see this is a move. You see this? I'm in the wrong place. There we go. I'm telling you now, when you see this on a 5-minute chart, you can expect to move to the high. In this case, because of what I saw in the background, I would expect higher prices. I say you would expect for what is today? 9/3/2024. You would expect right now that Pepsi has a breakout. And you would expect that to break higher than 183. You see, the last two staples didn't show substantial volume right now. Why not? Well, they've made their run. They've been transitioned. This is why when you find a laggard in a leading sector, so you found a lagging stock in the top 10 of a leading sector at the moment, or a historically leading sector. So historically, staples have led the S&P 500 in September, and you found a lagging stock that all of a sudden has a ton of trading activity coming into play right now, and it's lagging the other two companies we looked at, which were Coca-Cola and Procter & Gamble. That is ripe for a move. Let's see, NSRGY, that's Nestle, UL, and Walmart. Okay. Let's go back. Real quickly, everyone. I'm going to start. I had overwhelming demand for my mentorship in August, which got started last week. So I'm going to start another VIP mentorship in 2 weeks. And what I want to tell everyone is I would encourage everyone to have a much stronger focus on my one-on-one coaching sessions. The mentorship is great. Don't get me wrong. It's amazing. It's an amazing 8 weeks. In my opinion, you'll learn more about the real world and finance in those 8 weeks than you've probably learned throughout your life. And definitely if you've only been tuning into the very standard financial information, because that's really there to kind of lead you down the road that you're meant to be led down. And if you haven't noticed in the last 4 years, that road typically is a road to profits for others and not for the individual. So if you have more knowledge and you are the stronger hands in any industry, you are leading folks down the path to profitability for you, which is oftentimes not really the best path for them. So that is the case in this industry also. So what I would tell you is I have a VIP mentorship starting up in 2 weeks, but I would strongly encourage you to consider the one-on-one coaching over the VIP mentorship. I want to do something here. I'm going to put my Twitter handle for those of you that are not following me on Twitter. You should be. I put so much information out on Twitter that it makes no sense not to be. Let me add that there. Okay. My mentorship starts in 2 weeks. dmiller@prometheaninvesting.com is my email address. Please leave your name, number, and email address so that I can get a hold of you and make sure that what you're looking for, this mentorship program aligns with. Also, Derek Invests at Derek Invests on Twitter is where you can find a lot more information. I stream my lives there every day. I do on Twitch, Kick, Facebook, Instagram, LinkedIn, YouTube. So I have a lot of stuff going, a lot of social media information. But look, if this stuff interests you, if you can see what I'm talking about makes sense, I have a mentorship starting in 2 weeks. I do limit seats. That is not a joke. I had to turn a few people away last month. So if you are still interested, hit me up this month. dmiller@prometheaninvesting.com. Your name, number, email. Also, leave your time zone or where you're from so I know a time to contact you that makes sense. And then ask about the one-on-one coaching. The one-on-one coaching is if you're serious about investing and if you have serious money in investing, like you are investing yourself, and it's your retirement account or you're young and you want to build this account into something truly meaningful, the one-on-one sessions are the place to be. If you're not following me on Twitter, you'll get a lot of information there at Derek Invest. All right, let's hide that again. And let's go back to let's get back to what we're doing. NSRG, which is Nestle, UL Walmart. Okay. NSRGY. There we go. Oh, this is really lagging. In fact, you could take this a little further. This has gone beyond lagging into it is weak within consumer staples. But do you know something interesting that hits me right away when I look at this monthly chart? This right here. Take a look at the trading activity occurring right now. What month did this start? This started in January of this year. The trading activity is at a price that went from 140 to 100. So it's a 40% drop, everybody. And there has just been an increase in volume. Look at the preceding volume. So what you want to look at when I say that there's high volume, remember, it is relative to the preceding volume. This, and I'm going to change the color of this so it's more obvious. This is your preceding volume. Oh, that color doesn't work. What about that one? No, that doesn't work. Let's go with that. That's terrible. Yellow. These colors aren't very bright, are they? Blue? No. Purple? But it's fine. So when you look at the preceding volume, in fact, I'll just throw this, which is way down here. I'm going to make it a red line, even though it's going to disappear in there. We have a ton of volume this year in Nestle. All right. So this interests me because it's after a 40% price drop. This is the stuff you're looking for, folks, when you're looking for buying opportunities. This is a 40% price drop. So let's put that up here. A 40% price drop followed by a massive increase in volume. So traditionally, I'm going to change this arrow and put this one here. So traditionally, this would be buying of institutions because the volume from 2020 until now has been, lackluster at best. It's terrible. And all of a sudden you have a huge pickup in volume right now. So in 2024. So this is of great interest to us. This is something you want to zoom in on and you go, okay, this has, it looks as though it has some very definable risk, which is what we look for. We want definable risk, but we also want definable upside, everybody. You want definable upside too. You don't just want definable downside, right? Does that make sense? If you don't know where something's headed, you can't draw a path to where you believe it's going. And if you can't, look at the volume now. How does it look now, everyone? Look at this volume. That's in 2024. This is not a small time frame. This is all of 2024, okay? This is 2024. Week in the market. I agree. It has. Well, Derek, you always say, not to buy weakness. Right. I don't want you to buy weakness. Right now, what we're doing is we're not saying this is a buy or not. We're not saying anything. Right now, we're saying this particular position is a position thus far that we would have a high level of interest in. And now we're going to move in to the daily. This is a great learning tool, everybody. You should be here to learn, right? All right, so there's so many gaps on this chart that you really can't pay attention to them in Nestle. Now, why would you say that is? Is it trading volume? I don't know. You have 500,000 shares traded a day, not necessarily. That's not on the high side of volume, obviously, but it's not on the low side. Like, that's all right. There's not a ton of manipulation going on at 500,000 shares at $100, right? There's not a ton of, you're trading 500 million a day. But there are gaps everywhere. Do the gaps appear to fill? Yes, but they're not the best price targets. This volume here is really interesting. Keep zooming in. Look at that. That's got to be 5th, right? The 5th? No, it's August 22nd. Gap down, pulls up. This thing's building energy to the upside. There is no doubt about that. Is there a reasonable downside target? Now, even though there's gaps all over this chart, this thing fills gaps. So right now you're looking at 107. That's only 35 cents below you. That's not even worth taking a look at. Let me come back to 104. I mean, look, this one might be one where you have to give a higher upside target over a longer time frame. I mean, it just is what it is, everyone. It doesn't have, you can say long term, this looks like it is being bought at a very high level. Why, I have no idea. So if you were a long-term trader, you could very easily, like safely assume that you're going to have, I'm going to make this blue because that's to the upside. You are going to have, and listen, for those of you that think only short term is the path, well, you don't know a lot about taxes and taxation. When you're building a portfolio, you have to pay attention to your taxes as well. Taxation is very important. So if you're looking, let's do 9/3/2024. We're going to do RGY target 143. Because we are in the fall officially, you can say this is a 6 to 12 month move. Because it is a consumer staple, you have to allow a little more time with this thing because staples don't move as quickly. So if you have a 2 to 5 year outlook on this particular company, target as I'm talking, I write staples, of course, target date. If you have a 2 to 5 year outlook on this, and I would be fairly certain this would be within 2 years, and it's 40%, folks. This is 40% in the next 2 years. If that to you is it doesn't appeal to you, well, there's going to be an interesting path that will get laid out soon enough as well. But right now, what you can say is if you're a long-term or you're looking for investments to exceed the 12-month capital gains rate because you live in the United States, you just found one that has tremendous upside. It has definable upside, definable downside, which you're sitting at the downside. The downside's $100. The upside's 143. This is a great position. This is most likely a long-term position that I would be interested in, and am interested in, to be quite frank with you. When you're managing your money, you need long-term positions as well as short-term positions. So UL, Walmart, where are we at here? We're at 30 minutes. Okay. I'm sure I still got some hangers here. I know that some of you tune in for the entire show, which I really appreciate. And I appreciate all of you that tune in. And I appreciate all of you that open your mind to the fact that, hey, maybe what I've been told about this isn't exactly accurate. Whoa, this is a very interesting chart as well. Unilever. Look at this. How's this for some volume, everybody? How's this for some volume? Now, the only thing you can say about this volume is you've got to be careful. This volume's taking place on a breakout, on a long breakout, right? Like is this making, I don't know if it's exactly making a new high today, but it's sitting at a new high, which means it's going to get a lot of pushback. I like this though. So this has been building up steam since $52. We're at $64. And how long ago was this? November of 2021. Your low side is 42. It looks like the buying started at low 46, high of 54. So 50, 42. This is where your buying's taking place. And now you're breaking to a new high. You probably can say that 50 is your downside. You're sitting at 64. You're breaking to a new high. Let's wait. Let me get rid of this drawing. Let's zoom in and have a look here. Let's take a look. Weekly, is anything happening at this high? No. So all of that buying that we saw is there's no selling to coincide with that buying, which is probably has an average cost of about 50, right? It has an average cost. So you're up 30% right now on that position, but we don't see selling, not on a weekly chart. Let's move down to a daily. Now there is a really big gap down here. What price did I say, everyone? Did I say 50? That I did. That I did. And believe me when I tell you, I do not go through this stuff before I get on these lives. I don't need to. I have no interest. And here's something. You're down here at 48, everyone. Does that mean it needs to reverse to 48? Well, no. It doesn't mean it needs to. Not now. You're looking at a daily chart, 6 to 12 months. You're on a individual position, Unilever. It trades what? I mean, 2-4 trades a lot of shares, 2 to 4 million a day. I mean, what did it do here? And this isn't. This is here. So you would think this would want to that's just, what it is. Let's zoom in. This looks like there's been a lot of buying going on. Was the way to survive the 2000, 2003 50% market drop. I mean, if you were rotating sectors in 2000, 2003, you barely felt that move. So people that don't believe in sector rotation are fools. There are plenty of bear markets you can point at to show that sector rotation works. Now, there are a lot of bear markets where it did nothing. When you have a massive global economic event like we did in 2008, and I believe that event was caused because strong hands got a little too cocky, drove prices a little too far down. They scared the hell out of retail. They lost control of the market. How rarely is that? How rarely does that happen? I think it's pretty darn rare. And I think that 2008 taught them that greed has its limits. So I don't expect an event like that maybe ever again. Okay, here we go. This is a good short-term price target. We're in on a 30-minute chart. You're looking down at 62, right? You're sitting at almost 65. That's a 5% move. Let's zoom in and see if there's anything right now that would tell us that move is yeah, I mean, there certainly is. See this volume? Look at this. We're on a 15-minute chart. Look at the volume here. Look at the trading activity up here at $65, right? 64, 65. As we know, the market is a business. That business is run by companies. Those companies are the foundation of that business. They have mechanics that they follow that allows for market corrections, big and small, and market recessions, big and small. So those mechanics elicit emotional behaviors because we're human beings. So what we want to know is, what do those mechanics do to the emotional stability of those on the other side of the trade, which is the weaker, less knowledgeable hands, right? AKA retail. And right now, when I see volume like this, I say, well, this is institutional hands at play. It's at a high price, a 5% pullback. We said their average cost is probably 50. You're at 65. That's a 30-some% run. To have a 5% pullback makes perfect sense, which makes this a great price target. We have the volume. We have the reason behind the move. We understand that it is a move based on structure, based on mechanics that a business works within. It's the same thing as like if you own a t-shirt shop and you have one t-shirt that everybody wants, it's reasonable to believe that you would drive up the price of that t-shirt. Now, as demand decreases and you want to sell that t-shirt, what will you have to do? You'll have to drop the price. If demand is decreased and you still want to sell the same amount in volume of that t-shirt, you'll have to bring prices down. Thereby, you should increase demand again. Because when prices drop, if it was a t-shirt everybody loved, people are going to go buy that t-shirt. Hey, the price on that t-shirt dropped again. We got to get down there and get it, which will drive prices higher again, right? That's the structure of the stock market. So this is very reasonable. Let's zoom into a 5-minute, although I'm going to come back to this chart regardless. So on a 5-minute chart, as you can see, this had to fill. There's a gap at the high that has to fill if they're going to drop at 5%. So that gap has filled. There's no need to talk about this any longer. So what we're going to do is we are going to go back to the 15-minute right here. We are going to, we could put a big smiley face emoji there. Delete that. That was an accident. There we go. There we go. We are at 9/3/2024. We are looking at UL, which is one of the top 10 consumer staples, everybody. We're looking at a price target of 62. We are in the fall. We are on a 15-minute chart. So this should not take more than 2 weeks, which would also justify some of the weakness we saw in general in consumer staples, doesn't it? So if consumer staples is showing general weakness and we take a look at something that looks like it wants to break to new highs and we see that general weakness, so it's the 3rd. So 2 weeks from today is the 17th. 9/17/2000. It shouldn't even take this long. As you know, I am always conservative with my price targets. If you think that's too far out, well, go somewhere else. Just kidding. You should have trades along all time frames. If you are properly managing money, which is comprised of risk management, cash management, and investment management, you should be working along different time frames within your investments. You should not be operating on the same time frames. If you operate along the same time frame, what do? You increase risk. Why? Because if you're wrong, everything gets hit. Reducing risk is key. That's one way you can reduce risk. All of my students that work with me one-on-one completely understand we are always looking for positions that have upside targets and downside targets, and we're working across different time frames as just two pieces to our risk management. Okay, let's take a look at Walmart. Woo, baby. Fair to say that's on a run, huh? Now, did it break out and return? Sort of, because here's your breakout. It returned. There's your breakout and a sort of return. It's getting a parabolic run. So while a lot of people would be in love with this particular position, I don't like stocks that go parabolic. What's parabolic? Up, straight up. We're on a daily chart. I see a gap at 68. Obviously, we're going to explore that. I see a gap down at 61 as well, which is showing some of that weakness we talked about that we saw in general in staples. Let's zoom in on this and see how long it lasts. We're going to look for a near-term target. We're at 1 hour here. What is there? Earnings back there? Of course, there's earnings used to drive the price higher so that institutions have the opportunity to sell off. I don't see, to be fair, I don't see a ton of selling. There's definitely some occurring, but I don't see a ton of it. We're probably not at the place yet where this starts pulling down, but you could start building into your short, and I'll tell you why. This is definitely a target that you should be looking at, a monthly target right here. I'm going to post this because I love this as a monthly target. Sure do. It doesn't appear as though the move has begun, but you should understand how to scale it. You should understand how to scale in and out of positions if you are trading your own investment account. If you're not scaling in and out of positions and you don't understand why you would start scaling into a short at this level, or you don't understand what scaling is, again, one-on-one coaching is definitely for you. Walmart. I don't want to pitch that too hard because the truth is I only want people that want it. I only want people that get it, that say, hey, I can see where I've gone wrong. I can see that this makes sense. I do not look to convince people to do this, right? I look for those that are already searching, and I put the information in front of them that proves I know what I'm doing and I am consistently accurate. And it doesn't matter what I am looking at. Target date. We're going to give this a month. We are looking at a 30-minute chart. I am telling you that it doesn't look like the move has begun because it doesn't. But it may have. But I would start building into my short position now. This is a great short-term move for sure. It's only a month. So this is a great short-term move. Start scaling into that short. You don't always have to be playing options, everyone. You don't always have to be playing futures. This is a big move. From 78 to 69, right? That's well, call it even if call it 78 to 69. You have an $8 move. You're looking at 11% move on a stock in a month. If you were to find, one of these once a month and only put 10% of your portfolio in it, meaning all you're risking is whatever downside in that 10%, right? So maybe you're risking 3% of your portfolio, but you're getting 10% moves. That's a guaranteed 12% per year in performance with little to no downside. A lot of ways to run portfolios, folks, and that's why it's so individualized, because that might be you. You say, look, if I'm making 12% with very, very low risk, for me, that's heaven. Well, I don't know why you'd ever look at an option. I don't know why you'd ever look at a future. I don't know why you'd ever look at leverage. You don't need it, right? Let me take a look at time here. I know how I get. I'm at 40. Yeah, I'm at 45 minutes. We're gonna shut it off at Walmart. I'll do some more tomorrow for sure, and I'm also gonna get into utilities. Oh my gosh, I was not screen sharing. I stopped the screen share and I never turned it back on. So you did not see the evaluation of Walmart. I'm going to real quickly pull that up, although most of you, I'm sure, have tuned out due to that blunder. But this happens on lives, everybody. I mean, what do you want me to do? I was live, and so here is your gap if you're still watching on Walmart right there. Okay. Don't need that. Let's do this. Right there's your 69 price target. Why are we looking at this? I'm going to go back and show you right now. Let me remove these two drawings, and then I'll do real quickly. I'm going to go back and do the last stock to UL Unilever. So why are we looking at Walmart, everybody? Let me go back. Because Walmart's gone parabolic. You see this upward move from 52? That's parabolic. That's just straight up, all right? So there has been a move into Walmart for sure. And I know Costco's on this list, and I didn't see it listed, so I'll be taking a look at that tomorrow too. So there you see it going parabolic. Anytime anything goes parabolic, it interests me. And then on a daily chart, we're looking at gaps. You see gaps on a daily chart on something that's gone parabolic and you don't pay attention. That is a big mistake, everybody. Let me go back to UL. I'm going to show you again here real quick. Has this gone parabolic? Let me show you. Let me let you decide. Nope, but it's breaking to new highs on high volume. Since 2022, it's been building. Average cost probably around $50. Here you go. We zoom into the week. Daily. I apologize for missing that screen share, everybody. Here's your gap. Here's your gap. There's definitely weakness there, and there's weakness in the underlying sector. Yeah, it happens on lives. I apologize again, everybody. If you're interested, here's my email address. I have a VIP mentorship starting in 2 weeks. It's the best 8-week course you'll ever take in your life in regards to finance and investing. If you ask me, I've never seen anything quite as good as someone who's actually trying to manage their own money. I've never seen any course that dug as deep as I do and taught you how this stuff really works the way that I do, the way that my system works. But I strongly encourage the one-on-one sessions. I think those are where it's really at. That's just my opinion. It's 40 weeks. I mean, it's long-term, and you need long-term, right? You want to learn how to surf in big surf. You're going to have to start in small surfs first, but you would better be training with someone that's done it before. Otherwise, it's going to be a painful journey. And that's what I'm here for, to help make that journey a lot less painful. If you're not following me on Twitter, I am at Derek, D-E-R-E-K, Invest, I-N-V-E-S-T-S. If you're not following me, you should be. There's a lot of information that I cover over there. There's a lot of charts I put up over there that I don't on the other channels. If you're watching me on YouTube, LinkedIn, Facebook, Instagram, Kick, Twitch, Daily Motion, it goes out everywhere. So anyway, look, thank you so much for tuning in, everybody. And listen to me. If you're not good up here, you're not good anywhere. If you're having a hard day, remember this: you're batting 1,000. You've never missed. You've never failed. How do I know that? Because you're still here. You're right now watching me, right? So you've never failed. I don't think you're going to fail now, right? But if you're having a hard time, get outside, get in the sun, go for a walk, smile, grin like an idiot, right? Fake it till you make it, everybody. I promise you, you do this for an hour, you'll have no choice but to lift your mood at least a little bit. You will, right? Hey, thank you all so much for tuning in. Love all you guys. Remember, every day above ground. Morning, everyone, and welcome to this episode of Derek Invest. I'm your host, Derek Miller. What we're going to talk about today are the 10 most discussed stocks by professional traders. So right now, especially after yesterday, NASDAQ had a 3% down day. S&P was 2+%. I'm not sure what the Dow was. I actually received several emails yesterday asking about whether it was time to buy, what to do, so on and so forth. So I thought this would be a good time to take a look at some of these positions. So semiconductors, stocks related to AI, and tech are very obvious positions right now that are in play. But there's another one that popped up that I was shocked about, which is Alta. Since Berkshire Hathaway took a large share in that company, took a large position in that company, apparently it's been the talk of the town. I had no idea. So we'll take a look at Alta. So we're going to take a look at, some of the usual suspects. So we'll take a look at NVDA, Meta, Amazon, Google, Marvel, AVGO, Apple, Tesla, and Ulta. We'll probably take a look at NVIDIA first. I had a student ask me about that yesterday, making some really good points. But I want to bring this up. I'm bringing up this student's question because I was sent the question via an email, and it had the picture of NVIDIA's chart, which was fine. But it was a daily chart, and it was asking if now is the time to buy back into NVIDIA. Now, this is why I'm always preaching that you have to have an investment plan established with established rules based on investment risk, cash, and investment management, cash management, and risk management. And what I mean by that is you have to understand how you're evaluating the position, how much risk is within the position, and how much cash you should be putting to play. Because the way the question was framework, there were several problems. And the one being, we're looking at a daily chart and then we're asking about a short-term entry. A short-term entry would never be taken based on a daily chart. A daily chart is for 6 to 18 months forecast. So if you're forecasting out 6 to 18 months, you're looking at a daily chart. So that's not a great chart for an entry. Okay, so there's your first problem. If you're looking at the wrong time frame when you're evaluating a chart, you could have everything right and be dead wrong because you're trying to evaluate an entry based on a long-term forecasting picture, story. That's what I call charts. They're the story of that particular position, that particular market. So you're looking at a story that's talking about, 6 to 18 months from now, and you're trying to apply an entry into that position based on the wrong time frame. That was the first thing. And then the second thing is now a good time to buy in? Buying in is never done all at one time, everyone. I hope you realize that when you manage money, and in this case, it's your own money, so the most important money in the world to you, you're not just buying into a position. You're scaling into a position. So you're buying pieces of a time. You expect it to hit this target price. You're at this target price. You're going to do a little math and figure out how much of your portfolio should be going in based on how much the price move is. Sometimes you get all the way to the target price. Sometimes you don't. But if you have good forecasting, if you have proper forecasting, you have proper risk management, which is going to give you target prices to the upside and the downside. You're reasonable with time frame. You have good cash management, and you're investing in investments that make sense for you. You're pretty unstoppable. You're pretty unstoppable once you put that all together. So the reason I bring this up is when I provide this information, when I go through these positions, you have to understand something. How much are you putting in? When are you putting in? Are you evaluating at the right time frame? Is this in the long-term portion of your portfolio, the short-term portion of your portfolio? How much of your portfolio should each be? Is this an investment that even makes sense for you? There's a lot that goes into this, and that's why I talk about my one-on-one coaching all the time, because when you come out of my one-on-one coaching, it's traditionally 40 weeks. Sometimes we'll double up on some of these sessions, so it'll be less, but then you may go away on vacation or holidays or whatever it is. And so sometimes it gets stretched out. But when you come out of that program, you have something built for yourself that you can use for the rest of your life. Now, you'll make adjustments as you go, because not only are you going to improve in your investing and trading, you're going to improve dramatically, which will probably, quote unquote, increase your risk, because you'll start to realize that risk is not really risk once you understand what you're doing. That may make no sense to you, but it would eventually make perfect sense to you. What someone might call risk, you call the safest bet in the market at that time. So those things are going to change, but you have a starting ground, and you know what time frames to associate with what you're doing, right? Is this if you're looking at an entry, what chart should you be looking at? If you're looking at an exit, what chart should you be looking at? If you're going long-term or short-term, you'll have all of this when you go through the one-on-one. So anyway, I'm done with that. I just wanted to briefly acknowledge that question and why all this information you're receiving. It's great to receive information. I love it, right? It's amazing. Like, Everyone knows where all the order flow is and where the orders are, and everybody understands. You can now chat GPT if you want to know the last bubble versus this bubble. You can use chat GPT for quite a lot of economic information, so that's no secret anymore. The problem is if you don't know how to put that information together, it really is truly useless. It's not going to protect you from anything. Information is just information without structure and understanding. Okay, let's move on. So I want to look at Alta first, then we're going to look at NVIDIA, then we're going to look at Meta, then we're going to look at Apple, then Google, then Marvel, then AVGO, then Amazon, Tesla. All right, let's take a look. Let me share my screen with you. There we go. Alta. Now, one of the things you want to do when you're evaluating anything, everyone, is you want to look at the underlying index, okay? When I say you want to look at the underlying index, hold on, we're not going to do that at the moment. When I say you want to look at the underlying index, like, for example, when we get into NVIDIA, when we get into some more of the tech-heavy stocks, what we're going to want to take a look at is the NASDAQ, what it's doing, and where we think it's headed, because that has bearing on where price is going to go in those positions. Now, when we look at Alta, which I believe is part of the S&P 500, you can see there's a gap on the S&P 500 sitting down at 544, 545. We're at 551 now, which that's only 1% in the S&P. However, go back to Alta here. It can equate to much more than 1% for a company like this. Now, let's zoom in on this thing. So you had a gap up, that gap filled on the way down. See this giant gap? This on a monthly chart. What do I tell you all about gaps on monthly charts? That is an indicator. If you were buying this at anything above 426, you were out of your mind. Out of your mind. Now, let's take a look. This is definitely an outlier as far as volume goes, trading activity. This is definitely institutional investors. This is last month, August. I mean, it's it takes you all the way back to, there's a couple in 2012, 2014, 2020. Anyway, it's one of half a dozen pieces of volume in the last, 16 years. So maybe there's 8 to 10 volume bars this high, trading activity that's at this level in the last 16 years. This is worth zooming in on. Let's head to a weekly. Okay, so here you are at the highs. Look at that volume. Now, that volume is right down there, 422 after the fall, because that looks like where this is being accumulated, or at least starting to be accumulated. 370. That's where the accumulation began. Let's go to a daily chart here. All right, let me see. Yeah, okay. So as you can see here, there is a monstrous gap that takes you all the way back down to 333. So this is, without a doubt, your downside. Your downside is 333. Whoop. Right there. Your upside is 500. So this is certainly definable, right? That's certainly definable, no doubt about that. What we'll do is we will zoom in just want to change that to reb. I want to make this red as well, just so it's easy to see. Okay, so this is certainly definable. All right, we have 333 and we have 500. Today we sit at 361. So let's go ahead and make sure we notate that we sit today. We sit today at 361. This is going to be a good stock to have looked at. I know a lot of you may feel you're not interested in this, but I can tell you already that would be a huge mistake. If you're not interested in this, you are making a big mistake. Now I'm going to stretch this back out. Now, why did I do that? Because I needed to see where this gap was, and I couldn't see it with the volume and the way it was. All right, so let's go ahead and zoom in. We're going to zoom into a 4-hour chart. There's that 500. Look at that volume back there. Look at this. Look at this volume occurring right now. After how much of a fall? From 580 down to 320, 315. Almost 50%. Almost a 50% market drop. Now you have all that volume stepping in. Now, as you can see, there's a gap here that fills, and there's a big gap below us. Do we believe that we're going to have to come here first? We most certainly do. Here's a gap on the way down. Look, it fills. See that? Here's your gap. Here's your fill price. Comes down, gap up, up, gap down. Has this filled? No. Is this a ton of volume and trading activity? My goodness, yes. Does it traditionally, would this be retested? Would you come back down into this 333 area? Traditionally, yes. Where did it get to? It got to a low of 342, which is pretty darn close, but you would still look at this as your possible downside. You would still, if you were going to go long right now, based on that 500, you would still plan to scale in from 361 to 333. Otherwise, you're making a huge mistake. Why? You're ignoring information. That's why. This is a 30-minute chart. This is a gap down. Gap fills. We should see a reversal back to 333 before that move to 500. Now, as you can see on a 15-minute chart, all of a sudden, what has happened? Well, that gap has disappeared. Let's zoom into a 5-minute chart. 5-minute chart, this has filled. This should reverse. We know that 333 is sitting behind us, but what did I say? We have to be at a 30-minute chart to get there. You're looking out 4 to 6 weeks. That's what this is. Like it or not, this is a 4 to 6 week time frame. Right there. Can it happen faster? Sure it can. It can happen much faster. But the likelihood that it happens faster isn't great. Odds are that's how long it's going to take. Now, what are we looking at? Alta. This is a great one, though. You have Alta 333. No. I like to separate these boxes. I think they're easier to see. Target date. You're really looking at 4 to 6 weeks. We're at the 4th. We'll just say October 12th, 10, 12. Nine, 4, 2024. Beautiful. Now, let's go back because there's an upside here at 500. Now, how do you know if you should be playing to the downside, how much you should be playing to the downside, and how much you should be playing to the upside? Well, you should know that. If you don't know that, if you look at this and you don't know exactly what you should be doing, you have to make some adjustments. You have to make adjustments. You are not investing or trading wisely. Period. This is your upside. I'm just going to call it 500. As I tell you, and as I talk to my students all the time, there's no reason to be greedy. 1% doesn't matter. 9, 4. I think my son's banging on the window behind me. You may be able to see him. I can't. He would be behind me. I'm not sure. He's funny, though. He jumps in these videos. All right. And now we're going to do Ulta. $500. Target date. Everybody, we are on a 4-hour chart. Target date. You are looking at year end. Now, how do you know if you should be building into this position now, if you shouldn't be? Do you even care about downside? You have to know that. That is personal. This is why I talk about the one-on-one coaching I do, or find it anywhere. I don't care if it's not with me. But if you are trying to invest and you are trying to have proper risk management, which means reduce risk to the lowest possible possibility, as low as you can get it, and you are managing your cash correctly, and you know what investments you should be investing in, you're going to need to establish that prior to making any investment. Moving on to the video. I had a student ask about this yesterday. Let's take a look. Is there anything here substantial? There was a gap back here. He mentioned a gap at 75. I'm not sure where he was looking. There is a gap down here at 95, though, but it did fill. A gap at 75. Maybe he's talking about this here. But look, this would technically, let's zoom in on this, actually. This is good to look at. We're going to go backwards. This is a good thing to look at. So he's looking at a gap at 75, so we have to keep going here. There's that gap at 95 that's filled. It's filled. He believes he said 75, so I'm still going backwards here. So I'm not sure. See, this is technically really not even a gap. See where price is? I mean, it did drop down and create some sort of gap, but it worked through it. There's a gap up, I guess, up to 75, but that must be what he's referencing. And should that gap fill? Well, you have to remember something about gaps. I'm going to go back. I need to get back to I'll go to a 4-hour, maybe a 4-hour. No. 4-hour. Let's see. Yeah, I'm not really sure what he's referencing. Maybe this here. This is a gap, but also that would not be anything reliable because price didn't actually float through this area. It dropped through this area. It rose, yes, but it's touching the previous high. It comes down and retests the previous high. This would not be a reliable gap as far as even a price target goes. It's just not. Let's look at what's going on now. If there's anything definable in the video, because I'm not really sure. But again, that's in individual positions. Gap theory, it's not that gap theory doesn't apply. It most certainly does. But in individual positions, you have to understand that there'll be small gaps, things like this that will never fill, especially on something running the way NVIDIA is. Now, how do you know that? Well, if you know gap theory, you understand why that is and how that works. We just hadn't gotten that far. We are not into gap theory yet. We begin that on Friday with the person that I'm talking about, which will be exciting. It'll clear some of this up. There's nothing definable in the video, really, aside from up here. You're going, okay, what does volume look like? Well, there's a lot of volume down here. You're sitting, I think it came in and touched 105. There's a ton of volume. There's a gap above you. There's another gap up here at 125. You would say NVIDIA is to the upside. Whether you should own it or not really depends on your risk assessment, like of yourself, like how much risk are you willing to take on? Because let me show you something. When you don't really have definable downside, and in this case, you really don't. I mean, your definable downside would probably be about $100, but that's not really it. It can easily pop through. I mean, the truth is, NVIDIA can very easily come back to $51. That would be your definable risk. That's the case. Like it or not, that's where it is. Your definable risk on NVIDIA is down here, $50. If you're comfortable, you have 125 on top of you, you have 50 below you. That's like the worst trade I could ever imagine. But depending on time frame, there's so much that goes into this. But if this were me and someone were just blanketly asking me, would I go into NVIDIA? No, I wouldn't. There's much better positions than this that I can make a heck of a lot more money in. Let's look at Meta. Meta got a nice price run because what's his face? Mark Zuckerberg started talking about AI, and that's where this pop came from back here. I remember when he started talking about AI, and all of a sudden it bolstered his stock price, of course, because right now with this new AI craze, which I have to tell you, I don't believe in whatsoever. Your definable downside on Meta is 385. You're sitting at 512. That is your definable downside right now. It just is. Do I think AI is what it's cracked up to be? I don't. I say that from experience. I'm dealing with Airbnb still over charges in this place I stayed in months and months ago, and we left on the 4th, and they're saying that it didn't get canceled to the 16th, and it was supposed to be canceled by the host, and that you had to pay 30 days plus the 9 days. But the host has sent me emails saying, no, there was no cancellation. Forward this on to Airbnb. Have them give me a call. They haven't called him. It's just a disaster. It's a disaster. It's all chatbot and this AI stuff. And so, yeah, no, I don't think it is worth its salt yet. I think this is going to be very similar to many of the crazes. We had Tesla go absolutely nuts over electric cars in the peak of 2021, just to fall 75%, because this stuff's being driven by market sentiment, not by actual results. It's really not. It is taking away jobs from humans, many, many humans. And I had a conversation with someone that is trying to, they're basically running an AI business or pitching an AI business. And this also looks like selling to me, by the way. They're pitching an AI business, and they said, these are jobs no one wants. No one wants to do this. Well, I have news for you. You ask a guy that's trying to feed his family and kids if he doesn't want that job, even though that job sucks. Oh, he wants it all right. He'll take it. He will take it. But it's not that AI is all bad. It's that it just doesn't belong in certain areas. It doesn't belong in healthcare. It doesn't belong in anything associated with customer service related to money. Banking, like Airbnb, for example. This is almost a $4,300 charge that we have been dealing with Now, so we got the initial issue worked out, which was a $3,500 issue. They straightened that out. Now they screwed up and they're trying to charge us almost $4,300 for a place we never stayed in a time we never stayed there. We have a great review from the host on their platform, and they can't seem to figure it out because they aren't they. They are chatbot AI crap. It's garbage. It's garbage. Meta, would I buy Meta? No. Absolutely not. It looks to me like Meta is coming back down here. We're on a weekly chart here. Wait, does it show up on a daily? Hold on, I'll tell you if it shows up on a daily. I wouldn't buy Meta. You can't define risk in this. It's upside, downside. It all sucks. I mean, you even have this sitting down here at 403, but I would say you're coming lower than that. I would say you're coming down to 385. Which is somewhere in here. Which, I mean, you could even use this. This is fine. This is where you're going to come. I don't care. Call it 400, but the reality is it's probably closer to 385. Now we can go back and we can take a look at we can take a look at the underlying index, as we should, and see what level of weakness we think we see there. Or if we see strength there, then obviously that means the Meta target would take much longer, wouldn't it? But I can tell you, Meta is certainly, this little pop is built on the fact that apparently Mark Zuckerberg now feels really bad for helping alter election results and stealing your information, and it's countless. I mean, I can't stand Facebook, Meta, call it what you want. That place as a company, I would, I don't and won't use it. That includes Instagram, sadly, but yeah, it's a farce. But I don't even judge positions based on my belief in the company, because what will drive price is the fact that this company operates within a business. That business is the stock market and publicly traded companies. There are structures within that. Companies, you have your investment houses, you have your brokerage houses, you have your financial advisors, your trading desk, your professional traders, and they work on mechanics. And those mechanics elicit emotional responses by the rest of the market that really doesn't know how it works. Those mechanics drive cash flow. They increase and decrease supply, which drives price up and down. That is how I make my decisions. And when I look at this, I say that I can't imagine a world where this doesn't revisit $400, because it only makes sense in line with this business, which is the business of publicly traded companies. It makes sense. So I don't know why it wouldn't come back down to that level. So don't feel that I get caught up emotionally with any of these companies. I absolutely do not. Let's take a look at Google. What do we see here? Well, obviously we see weakness. We see another gap down here at 143, 144, 145. Call it 145. Let's do something. Let's take a look at the NASDAQ and see what we see here. Now, we came down. Now, if you know anything about the bottoming process, there's a couple things you should know. So the first is this. When a market pulls off from a high, falls over 15% in the matter of 3 weeks, this was used as a fear mechanism. The mechanics behind this were very easy to see, because you can see where the gaps were that had to be filled. The reason those gaps have to fill is these companies want to get the best price. So they work within a business. That business has to remain profitable at all times. They want to get the best price. They gap through prices to elicit fear or to elicit excitement, period. That is why gaps exist. Everybody can give you the rigmarole on how it happens, why it happens, and so on and so forth. And that's not why it works that way. That's exactly why it works that way, is to elicit emotional responses, as most things in life are, right? It's why the candy bars are at the front aisle in a grocery store. It's why listen, I don't have to get into how marketing works, and I don't have to get into how life works. That's why you test drive a car before you buy it every single time. That's why they want you to smell the leather. They want you to hear the engine roar. The same thing with this. This is no different. It's a business based on human beings. You can see that there's a price target on the NASDAQ, which is way down at 378. All right. Now, how far is that? I think we hit 423 here. That's 50 points. That's another 15% down from where we sat at this low. Do I think we're going there right now? Right now, it doesn't appear so. But I will tell you this. Traditionally, when you pull off from a high very quickly as a method of producing fear rapidly, you would expect the rise up to fill all the gaps. In this case, we had a gap up at 490. We didn't quite make it there. We made it to about 486. So you came within under 1%. That, effectively, that is a fill. Now, when this happens, do you usually break this low? Not typically. If when you come back down, you start to see volume dry up. All right. Is volume drying up right now? Well, I hate to be the bearer of bad news, but no, volume was increasing yesterday. Okay. If we see volume continue to increase as we approach this low, that means there is more supply, more stock to be purchased before we rally to a higher price. If volume begins to dry up as we get down into this area, somewhere between 450 and 423 or 425, whatever it is, and volume begins to dry up, then yes, we should take off immediately. The possibility does exist to break this low. If we break this low, the first stop would be your 413. Your next stop would, in fact, be your 478. So there's some downside bias in the index right now. So let's go back to Google. Let's keep that in mind, that there is some downside bias. And let's go back to Google. Google has not really recovered since the drop. It is back at the lows. It has almost gone through its lows, which means there is an extremely high probability that Google's next stop is going to be right here. Call it 145. All right. Now, what we want to determine is when. So now we kind of see a price target. When should we be looking at that price target? That's the key, right? That's what everyone wants to know. When? Okay, so we have a price target. For those of you out there that play long term, going short and creating or building into a long to this point may not be a mistake if you believe this has long-term legs. The way you would know that is to zoom out even further, which would be a weekly chart. Does this look like it has long-term legs? Well, it's revisiting the high, which sits here at 150. Isn't that interesting that it's at 150 when we have a gap just below there at 145, which would bring you back into the previous high? Do I think Google has legs? I would say Google has legs, yes. So could you be building into that position of 145 right now? I don't see why not, as long as that was suitable for you, and you should know if it's suitable for you, right? I can't tell you if that makes sense for you. Now, when should you hit that 145? Well, we're on a 4-hour chart right now, right? So this takes you out about 3 months. You have a 1-hour chart here. And on this 1-hour chart, you have some price action above you at 183. So now you have definable. You have a definable position for the next 4 to 6 weeks with a high of 183 and a low of 145. So now you know how to play this position both ways, right? So you can build into both positions. We zoom in a little more. All of a sudden, that 183 disappeared. So if you zoom into a 30-minute, which would be over the next month, what do you see? Is there anything definable? Nothing that I see. Let's zoom into a 15. Anything definable here? Is there anything here telling you that it looks like we're headed for a market bounce? I would say we already know we're at the previous low. And I would say some volume stepping in, trading activity. Would I say that this is trading activity that would be associated with institutions? It certainly does not look like it. It doesn't look like institutional trading, but it could be. This could be they could be scaling into this, starting at 160 down to 145. They know what they're doing. They're not stupid. Is this a definable upside target 165. Sure it is. It's a definable target. You can say you have a definable target of 165. Now you can see how we understand where we're headed, right? So we have downside at 145. That looks like it's going to happen within the next 3 months, or that's our longer term target. Our shorter term target might be 165. Then you'll evaluate what it looks like at that point. But above that, I believe it was 183. And you go up and up and up. Okay. But Google right now, is this something that I would play? If I were looking out a little further, did I say I could see it at one? No. If I were looking out 4 to 6 weeks, I would say yes. You can build into your 145 and your 183 100% from here. You're at 160. All right, what's next? Where are we here? NVIDIA, Meta. And let's look at Tesla and Apple. Let us look at Tesla and Apple. Whoop, I almost spelled Tesla. All right, do we see anything here? Let me get rid of that drawing there. This is on the monthly. This is the 75% drop from 2021 because, again, the market is a business that has a foundation to it, which are companies, right? Investment houses, brokerage firms, trading desks, institutional traders, retail traders, and you have to profit every single day. Those people, aside from retail traders for the most part, operate on mechanics. Those mechanics elicit emotional responses from retail, which will drive prices based on cash flow. And that is exactly what happened in Tesla, and that is really what happens in most stocks. Okay, let's keep zooming here. So we know we have downside bias on the NASDAQ. Let's see what we see. So this is a gap down, it fills. This is a gap down, it fills. This is a gap up, it fills. Now, 2 gap ups, they fill, but this didn't fill. This didn't fill up here. Call it 240. Call it 245 even. This didn't fill. Right there. We're on a daily. Let's zoom in. I mean, you could argue that this gap has filled, but if you look at Tesla, the fact of the matter is it tends to fill gaps like legitimately. Although there's a gap up here that you still haven't returned to. So you have a 145 downside too, everyone. And you have a lot of volume at a high price. And you have 145 on your downside. What does high volume traditionally mean when you're sitting at a higher price? It means downside. But you went from 270 down to 185. I mean, look, you dropped $85. You dropped 30%, more than 30% from here. So you have upside of call it 245. You have downside of 145. Let's zoom into the 1 hour and see what we see. 245. 145's disappeared. But you want to take note of it. You want to acknowledge that its existence. You have a gap filled. You have a gap up filled. You see this. The reason Tesla is moving in the manner that it is, and it's filling its gaps appropriately, is because this has massive institutional traders in it. Massive. They want to get the best price. I mean, down to the penny on their position within their trading desk. But you're getting high volumes at this high price, 218. If you were asking me, it would be looking to me like the bias is to the downside. But there's nothing really definable here that I would say, oh, I would do this with Tesla or I would do that. So I'm not going to do that right now. There's really no reason to. Where are we at? So we're going to do Apple. Let's take a look at Apple. The fact of the matter is, if you see downside bias in the NASDAQ and you're looking at these stocks, you're probably going to see downside bias. I mean, that's the way it goes. But what you're really looking for is being able to manage risk so that you can manage cash. See, this has a downside. Apple has downside of about 200 at this moment. And you're 218. So you have 9% downside. Look how it fills its gaps. Did this gap down here fill? No, this is sitting at 170. Let's zoom in a little bit more. Yeah, that gap's still going to fill, everyone. Don't fool yourself. This gap for May is still going to fill. You have a gap here, fills, comes to a new high. This actually filled its high gap. Remember how the NASDAQ didn't make it to, the QQQ didn't make it to 490? It didn't make it to fill the gap? Well, Apple did. Apple's filling its gaps very, very, very appropriately. Again, it's a big player right now for institutions. Yeah, there's some real weakness here. I mean, there's no doubt about that. Even small gaps are filling. I mean, tiny. Look at this. That's nothing. Look at this. This is nothing. Yeah, they're all filling. We may have a surprise coming into the end of the year. I don't believe it's going to be September, though. The charts I'm looking at don't show a lot of negative action for the month of September, but definitely inside the next 3 months. I mean, when you look at a 4-hour chart, everybody, this chart right here, this is a 3-month chart. You're forecasting out 3 months with this, and I got to tell you, your upside is nothing. 236. Wait, let me just delete that. Your upside is nothing. That's your downside target. This is your upside target. In fact, I'm going to write that. Apple upside target. Now I'll come back and change that. Apple downside target. This is what is that? 175. 175. And this is 230, call it 237. 237. Change this to blue. I don't want it to be confusing here. Now, how you're building into this position, once again, depends on you. What is your risk profile? How much risk do you take? How much cash do you have on hand? How much cash do you keep on hand? Right? This information, while very, very accurate, doesn't mean much if you don't know how to use it. Whoop. Upside. Downside. And what I teach here is how to use the information, right? That is the point. How to use the information. So you're sitting at 220, your upside's 237, your downside's 175. And this is, let's change the color altogether. What about this color? Does that look good? That's not very bright. Let's do that. Purple, purple. And this is a three-month forecasting chart. Now, how do you use that? Well, that depends on you. But this is how you establish a real position. You're going to scale into this in two directions, potentially. One direction, possibly, depends on you. You might also be using some derivatives for one of the directions. We saw a bias in the underlying index. We've seen downside bias in the underlying index. We've seen downside bias in the other major stocks within this index. So it's really on you on how you use that information. So again, let me go over here. Where is this? Oh, who cares? I'm just going to show it all. Show. Where am I? There we go. If you're not following me on Twitter, it's at Derek Invests. I post a lot of charts. I post a lot more information there. Follow me there. That's on Twitter, at Derek Invests. LinkedIn is Honest-Trader. I am also on Twitch. I am also on Daily Motion, YouTube. I'm on everything. Instagram, Facebook. Even though you heard me say what I said about Meta, I believe what I said. But anyway, follow me there. Definitely head on over to Twitter at the very least. That way you can learn more. There's more information there, more information utilized. One-on-one coaching, email me at dmiller@prometheaninvesting.com. Leave your name, your phone number, your email, and where you live so I can look up your time zone and we can figure out a time to talk. All right, that's it for today. Thank you so much for joining me. Remember, if you're not good up here, you're not good anywhere. If you're not feeling good today, don't worry. You know why? You're batting 1,000. You've never lost. How do I know that? Because you're still here. If you're having a hard time, get out in the sun, go for a walk. Put a stupid smile on your face for an hour, and it'll start to take hold. I promise you. Fake it till you make it if you're not feeling good. It will work. Thank you so much for joining me. I appreciate everybody and all of you out there. Remember, every day above. Good morning, everybody, and welcome to today's episode of Derek Invests. I'm your host, Derek Miller. And what I want to talk about today is some, we're going to look at some commodities. We're going to look at some crypto. And I want to look at a few more of the tech companies that are involved in AI and also being very actively traded by professionals and institutions. How do you identify if they're being actively traded by professionals and institutions? Really, really simple. Volume. All right. When there's certain levels of volume occurring and they're occurring day in and day out, these are companies actively in play on an institutional level. I always sort of have a thought for the day, and I think I'm going to start calling it that. So the thought for today, I watch all day as I scroll through social media, and I don't do a ton of it in a given day. But when I scroll through social media, I see all these guys, most of them young guys, talking about levels and how they're teaching a course, and there's this level here and there's that level there, and there's a Fibonacci retracement, and there's the moving average, and there's all this. And a lot of times when you watch me, you'll hear me poo-poo that stuff. Say, look, you're looking at lagging indicators pretending that they're forecasting mechanisms, and they're not. They're lagging indicators. But this is what I want to tell you. Let's pre-assume that all of those things are true, that you're able to use a lagging indicator to forecast. Never been done in history, but let's pre-assume that you're able to do it for argument's sake. The fact of the matter remains, and this is the thought for the day, if you don't know yourself within trading, if you don't have a set of rules that you follow where you know exactly what you're going to do with your cash management, your risk management, and your investment management, all of those indicators, pre-assuming they work, will not matter. You will fail. Understanding the mechanics of a market, that's step one. And that's not easily done. There's a lot of people out there pretending that it is. I've been trading for 5 years. After 5 years, I think I had only blown my account up once. And I would say I was okay in the trading world, trading and investing world. And I did it right. I didn't go out there and jump directly into the 25-foot surf, right? I did it the right way. By the time I hit 10 years, I'd blown up my account 3 times, but I had become a master at that point. I've been doing it now for 25, and you sort of even transcend that master status at a certain point because most of it becomes very intuitive, as do the rules that I follow become very intuitive to me. But to be back to, so let me circle back. So to circle back to these moving averages, these mechanics, support, resistance, breakouts, volume, all of these things, all of that is completely useless if you don't know yourself in the trading world. Let me give you an example. So for me, right, I grew up as a wrestler, all right, probably the most painful sport that exists, real wrestling, obviously, not WWE. It's a sport that it's all up here. I mean, wrestling's all up here. The mechanics of wrestling, you can go online. There's lots of cool, you'll see guys pull off some pretty cool stuff. But the fact of the matter is, if you stick to the basics in wrestling and you are in your better conditioning and you're willing to take more pain than the other guy, he can never beat you. It is a sport of intelligence, of pain resistance, but it builds the mind more than anything because you learn how to just ignore pain. So you have to understand something when you're dealing with me. And anyone that's ever done a CrossFit workout will tell you this. CrossFitters love to have me in their workouts because when it starts to get really painful, that's when I really come to life. That's my pleasure space. When it starts to get like, and people start really, I feel the same way, just so you know. I am in the same pain everybody else. I am pushing as hard as everybody else, but that's when I start to make jokes. That's when I start to I like it. I want it. That's my personality. That's who I am. So when you say, so you take that into a trading world, right, where other people set limits at support or set limits at resistance, I don't believe in that because I know that's built for 90%, 95%, 99%. I don't know the percentage, an extremely high percentage of traders, they can't take it beyond that pain point. That pain point is also a pain point that a lot of other people recognize. That's why you often see it pop through a few points and pull back, right? False breakouts. False breakouts happen to the upside and the downside. So that's just, but sometimes the entire range is false. And that's where mechanics come in. You have to know how to do that. But if that's my personality, but your personality, and if you talk to psychologists and all, they're going to say, well, he must have had a traumatic past, blah, 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 blah. I did growing up. And maybe that is why. I have no idea. But I know that about myself. Okay? Now, if you're the kind of person that enjoys yoga and peace, first off, being a trader may not be for you, but it may be exactly for you because the psychology behind it all, you may find very interesting, and you may be able to really sit in that and just relax as things occur. I have that ability as well to just relax. I don't get wound up, right? So, but if you're that kind of person, volatility is not going to be your bag. You're probably going to be somebody who is looking to swing trade, hold positions for a couple weeks, a month. You're looking for those long trends. You're just going to make sure things don't break. As long as they're not breaking, you're going to ride it, right? Whereas me, I like it. So I like to go a lot shorter. I like it to be fast. I like volatility. These are the things you have to know about yourself and you have to learn about yourself before you start actively investing in trading. So for all of you out there that are dealing with any mechanics in the market, I don't care what they are. I don't care if it's order flow. I don't care. I know a lot of guys follow the Greeks. And I'm not telling you these aren't tools to utilize. Even all of the indicators I just mentioned are all tools to utilize if you choose to. I'm not telling you not to do that. But if you don't know yourself, If you don't have a plan that is designed for you based on your personality, based on how much money you have, based on how much risk you're willing to take, based on what investments you should even be looking at, and then how much money are you putting into investing? How much should be left in cash? How quick are you on the draw? How early do you get out? If you don't know this stuff, it's not going to matter. You're going to lose, guaranteed. Because what really drives markets are humans. What humans do is react to emotional stimuli. And the people that run this business, the business of the stock market, they are well aware of what the average person can and cannot take. And they have the pocketbook to make that happen. That's the end of my speech. Let's get into it. So what do we want to look at first? I say oil, because oil has been looking like a fun place to be right now. So let's go up here. Let us take a look at oil. I'm going to zoom out to the monthly chart, as I always do. And let's take a look at what oil has to offer. Oh, we're going to have to zoom in. This is gosh, this was such a great run. I had so much fun during this. I mean, this run right here was one of the easiest runs ever. I remember this. This is where it pulled from like 58 to 44. And I had people, I was in a martial arts dojo at the time. Oh, what about that pullback? I go, oh, you better be buying the farm there. I started buying into this thing. I forget where it was. It was somewhere around 31, 32, and just rode this thing up into like 91. And then I finally I sold out. See, it's funny. Oh no, here it is. It goes even higher. So it's saying the high is 92.20. I'm sure that's correct, but we sat up in this 90s area for 4 or 5 months as I was scaling out of my positions, which, by the way, is another thing that you would better know how to do if you consider yourself a serious market participant, investor, trader, what have you. If you do not scale in and out of positions, this is going to be a very tough existence for you. So if you want to know how you knew that you should be in oil, if you look down here after like a 80% fall in price, you had the largest volume you'd ever seen. How did you know to get out? Well, basically the same exact way. You got up to 92, and it was just as blindingly obvious what you should be doing. Here it is right here. What is that? What's the price up there? What's the high? The high of 87.84. If you didn't start scaling out here, you don't know what you're doing. Plain and simple. Okay, let me get rid of those 2 arrows. But that's how you knew where to buy, and that's how you knew where to sell. It is not a difficult thing to do. And then along the way, as you break down charts, as you break down time frames, depending on how active of a trader you are, there were a lot of in and outs in oil. There were a lot of in and outs. It was really, really fun. And it looks like we're seeing some of that again. So let's see, because we bounced from 84, 85 down to 69. And this range is an interesting thing. And I've talked a lot about this range. So let's go ahead and zoom in on this range. This range exists to either build up steam to drive much, much higher, or to fall. Now the average guy on the internet's going to go, look, see this range? This has been so easy. This is your high price. This is where you sell. You know, this is your low price. This is, well, hopefully they understand that's the real range. But even though you have some prices popping out, hopefully they understand why those don't count. But this is the range. Right now you're in the middle, right? So it's like you go up, you go down. That is not how it works, by the way. So I hope you don't actually believe that. Within ranges are used to build, or they are used to, when I say build, they're the professional traders and institutional traders, the more knowledgeable hands, are buying up a position. And they're creating fear within that position. So in this case, oil, so they can buy more, or they're selling off that position. And that means that they are trying to create FOMO, that you feel you're going to miss out. You're missing out. You're missing out. There it is again, to get retail to buy so that they can sell. Because look, when retail is buying, institutions are selling. When institutions are buying, retail is selling. It's like Warren Buffett says, I buy when there's blood in the water, right? What he means by that is when fear is at its highest, he is the most interesting in purchasing. And as you can see up here, you know, this is selling at 84, which is where the selling has been occurring. Now, this right here, as you can see, the interesting thing here is the lack of volume. What does a lack of volume mean? Well, first off, it's July 2nd, July 5th. So you're going to want to pay attention to the fact that it's before and after the July 4th holiday. But what that does mean is there was no interest in prices at this level, and they did not have the amount of supply necessary to drive through the previous high price. So prices pulled back down. Now, what you would look for down here would either be very high levels of volume like this back here, because if you see a very high level of volume down at the lows, which is right now about 65, I remember we bought back in somewhere around 56 and have been playing oil ever since. And that is my DCA. That is where I dollar cost average back in was about $56 after selling up there around 90. And my original purchase price was down around 30. Right now, what you're going to look for is as it returns down here to the 65 to 70 level, which we were in, I think we were in the 70 level yesterday. Yeah, we were. Once you're in the 65 to 70 level, you want to see if you can get a massive piece of volume, institutional volume, like this right here. Here, let me just point to it. If you can get a big, large piece of volume like that right there out of the institutions, well, I can tell you now that what you're going to be looking at is a huge price move. If you don't get that, because this right here, this institutional buying that took place created this price run from 67 to 83. All right. So, and then at 83, what happened? Look at 83. Look. There's the selling of the buying, right? So you bought here, you sold here. You created some FOMO up here, you sold off to retail. Down here, you created some fear, you bought some from retail. It's pretty straightforward. And yes, you can forecast that. You don't have to wait for it to happen to then assume. Now, as price comes back, I would call that a semi-significant volume there. It's probably one of 15 places where trading activity was this high within how long is this? About a year. Yeah, about a year. Let's zoom in a little bit more. Let's take a look at what's going on now, because that's really what we're interested in. So as we look at this chart, do we see a lot of gaps, and we see those gaps filling? Yeah, listen, in commodities, you're going to see a lot of gaps. That's a snappy price move, right? It just is. That's what it is. And so it'll generate a lot of gaps. So you want to watch and you want to pay attention. When you're looking at commodities, what you want to focus a heck of a lot more on is the trading activity and where that trading activity is taking place. So here you're looking at what, $75? What's the low? The low there is 73, 74. You got to run to 79. Is that insignificant? Is $5 insignificant? In this particular position, I don't know. I mean, 3.5%, I guess. I don't know if it's insignificant or not. Here you have a bunch of activity in the same place. Now we're getting down here into the 69, 70 level, and you're having that same level of trading activity occurring down here, low prices. Let's zoom in a little bit more. What's this price level here? 74. This trading activity doesn't look as significant, but if you look back here, you'll just see like a tower kind of popping out of nowhere, right? Like there's not a lot around it. It's like looking at a small town, like looking at some place in the valley. Like you're looking in the valley and there's one big tall building back here. But over here, you're starting to see a pretty sizable cluster, and volume is picking up, aka trading activity, aka cash flow, as you reach these low prices. And it's happening in a larger amount. And look at this. All right, let's zoom in a little bit more. Let's see if we see something. And with a commodity, just because commodities are extremely active does not mean, and they generate huge gaps, that doesn't mean that you have to play that game, right? You can play this over the longer term if you want. Now, if you're doing that, is now a time to buy? Well, no. Why not? All right, well, let's go look. By the way, on this 5-minute chart, you're probably looking at two pretty substantial price targets here. You have one there. You have one here. Right? Because gaps are filling. And first, it looks like you have to come back down to about 69.50, which is what? $1.50 away from where you sit now. But you do have two pretty substantial price targets here. This one's up at like 70, just call that 76. This one's at 74. Oh. This one's at 74. You're on a 5-minute chart. So you should be looking at what? The next week. So usually or traditionally, this is nothing more than 2 to 3 days. Right now, we're still, the 5-minute chart's still looking at 2 to 5 days. It just is. That's the way it's running right now. I don't know why we're having this kind of muted response to things, but we are. So you're probably looking at 3 to 5 days here. Your downside is right here, which is about, what is this? 69, 65. This is your downside. Hold on, let's do this. Let's do 3 to 5 day upside target. Well, we're going to go ahead and change this back to blue. So that you know that it's an upside target and it's not to be confused. This is the same. This is a 3 to 5 day upside, 3 to 5 day upside target. And this right here is your downside potential right here. Now, you should know how to play this, right? So you don't have to be, and by the way, you don't have to be correct in the order in which all of this happens. You don't need to know the order in which it happens. You can see this. Now, is this even worth it to you? From 70.88 to 69.65, do you even care? Some people, they do. Well, absolutely they care. Some people care a heck of a lot about a move like that. This is what? We are 9.5. On USO. Some people could care less. Some people could care less about that. That means nothing to them. That little move, if anything, they'd buy more, right? But for some people, it does matter. And it would certainly matter if you get up into 74 and 77 and you haven't revisited 69. If you short, and you would evaluate it at that time, you know that target doesn't go away. It's not like because it doesn't go there first, all of a sudden it was meaningless and that target goes away. No, that target's a target. But what you have to know is, how do you invest? How do you trade? If you know the answer to that, then you know exactly what to do right now. Because there's your answer. Look, this is what's going to happen right here. This is what's going to happen. Now, how you manage this and how you handle this depends on how you invest and how you trade. What size should your position in oil be? What's your bias? Is it to the upside or the downside? I would certainly hope in energy your bias is to the upside, like from like an omniscient perspective. But what is your bias right now? So you're looking at this. What's your bias? Which direction do you see oil going? So if we pull up a daily chart, we can even pull up a weekly chart, because a weekly chart would be 2 to 5 years. So if we pull this up, is your bias to the upside or downside? Is volume telling you anything? Let's get rid of that cliff in the back, because that makes it really hard to evaluate what's going on right now. Is there anything going on right now that leads you to believe that it should go higher or lower? I mean, you're effectively in the middle of a very active range, right? Say from 83 to whatever I said down here, 60, 83 to 60. You're sitting at 70, 71. You're right in the center of a very active range. What should you do right now? Maybe what you should do is nothing. Oftentimes, you wait. If someone asked me what to do right now, I would say it's based on your time. What's your time frame? You're a swing trader, you're a day trader, you're a long-term trader. What are you? Because that's what's going to determine what you should do right now. How long is it taking to go from the base, from trough to peak, basically, right? So if you're at 60, this is June of 23. This is September of 23. June, July, August. This is the end of September. So 4 months. How long did it take here? From beginning of December, mid-December to April, 4 months. And you made a higher low. You didn't make a higher high. You touched the high again. If it were to reverse here, what would it look like they were doing with this range? They're building steam to go higher. I would agree with that, by the way. They're building a position to go higher. I would completely agree with that. I think that is absolutely what's going on in oil. I would most definitely have an extreme bias to the upside. I think that's where it's headed. For sure. Would I have a problem buying now? No, based on what I do, I don't have a problem buying now. That's fine with me. But is it fine with you? I don't know. All right, so that's oil. Let's take a look at gold. Gold is something else that's been really interesting because I think gold bugs still fail to realize that gold is nothing more than a yellow metal. It's not tied to a currency anymore. It doesn't really have much reason to go higher. You can say that it's for safety, but it's not. I mean, every time the market pulls down, gold pulls down. I mean, here you are in 2020. This is before the 2021 fall, but not very much before. And you went from where's 2021, by the way? So if you go to November, December of 2021, it's right here, January 22. So you're sitting at 172 is probably the low, November of 22, and you're at 150. You lost 22 points on 170. 11. You're looking at an 8% drop. Did it fall less than the market? Yes. Did it offer real safety? No. It broke out to a higher price. It then revisited the previous high price within the range. Now it's gone higher. So you should, if you even cared about this, you're still sitting here waiting for 180 before you'd ever buy it. There's no volume here that indicates it's going to go higher. In fact, there's volume here that indicates it's going to go much, much lower. If you're an intelligent investor, are you buying gold right now? No. I mean, you're bare minimum waiting for 180. And I've been saying this for quite a while. And let me tell you something. I am a patient man when it comes to markets and when it comes to investments. I am a very, very patient man. I will not make a mistake, period. Just because the world says that this is good does not make it good. And this isn't good. This is not good. You should wait for 180. If you look here, what happened? You had a range, and what was this? This is 163, right? That's kind of mid-range. What was the high here? Where you were generating some of the highest volume on this chart. What's the high price? 194. So you had 30 points. So not 15, not 12. So it rolled 10% higher to 192, and then it fell down to 150. So it fell 40 points, roughly 20%, little more than 20% from these high prices. Of course it did. It had to come back into this range, just like it will here. Just like it will here. But let's zoom in on gold. Let's see what's going on here. This is almost a price at which you would say, I mean, it's November of 22 through now. I mean, you're looking at 2 years of a price move. But this is, gone up very quickly, especially for gold. Let's take a look at from here. What's this? February 24. This is this year where it went from 185. Why? Because there's a lot of computer trading. There was a breakout of the high price. So computers bought, hence this volume right here. But guess what? This looks like a lot more like selling than it does buying at 225. And an intelligent buy point here is not prior to 180. If it doesn't pull back, so what? Get into something else. But that's not what we're doing right now. We want to evaluate this run up. How healthy does this run up look? Well, this high price right here of 224.88. It has a high price of 225.09, has some of the highest volume on this chart. As you come over, does this look like it has a substantial increase in volume? I wouldn't call it substantial. It certainly had substantial increase here, a very substantial increase. Now, let me ask you a question. When institutional money transitions money over to retail, what traditionally happens? Do you know what traditionally happens? Well, you can ask anybody that works with a financial advisor what happens, say 10 years ago. Most advisors don't even give stock picks anymore. They don't even offer stocks. They only talk about third-party institutional like mutual funds, third-party money managers. Most of well, no, that's not true. There are quite a few that do ETFs and ETNs. But bottom line is they're not giving you single stocks anymore for the most part. But those of you that were around 10 years ago, what happened when your broker advised you to buy a stock? You get a nice run up of 5, 6, 7%. Then what happened? It would fall 20 to 30%. Why? Because their trading desk offloaded the stock to you, and then the stock fell. Once institutional hands have no more use for holding something higher, it drops. So is it unreasonable to believe, looking at this volume, looking at the trading activity that is absolutely outrageous on this chart? This is an outrageous level of volume at 225.09 on gold. Is it wild to think that perhaps that was the beginning of the institutional hands to retail hands? Because price has risen 7 points. It's risen 3%. So this is evidence that this was not selling. No, this is evidence that this was selling. That's what that is. That is evidence of selling, not buying. As we come in, what do we see over here? Anything, like I said, with commodities, we are far more interested in trading activity and volume than we are in gaps, because commodities create tons of gaps. Gaps can be used as price targets as you really zoom in, because they do fill. But when you're looking out like this, you're not really going to be using gaps as price targets on a daily chart or a 4-hour chart. Trading activity back here looks pretty substantial. Right here, this looks like some substantial trading activity, right? But I wouldn't say right now it does. I wouldn't say over here. If anything, I mean, it's lackluster. It's falling off. The only possibility right now would be that there is no interest in buying at these prices, which is not very good for gold. But let's take a look. Let's look here. So you're creating a small range up here. Remember, every chart is a new picture. It's a new story, and you have to treat it as such. As I said, as you begin to zoom in, you can start looking at some gaps, and we can see where some bad behavior began around 220, and it's carrying itself from 227 into 229, but it reversed here. It filled. You see this gap fill. Did this gap fill? No. Does it absolutely have to? Well, we're on a 1-hour chart. That's still a little long to use gaps as targets in commodities. But would I say that this matters? Yeah, but that's only down at 220. We saw some substantial selling at 225. This looks like a cluster of volume to me, sitting up here to range from what? 228 to 233, 234. That's where all this volume lies, right here. So in this picture, in a 30-minute chart, you would say that there is some substantial volume at that high price. I would say that there is some more here. And what we're looking for, as you should know, if you watch me, or if you've been watching me, or if you haven't, let me tell you that when you zoom into charts, what you're really doing is shortening your time frame. This shortens the time frame for which you would hold any security. So as you get into a 5-minute chart, that's like right now it's a 3 to 5 day hold. Traditionally, it's a 2 to 3. You get out into 30 minutes, 4 to 6 weeks. As we go down to 15-minute chart, you're looking at 2 to 3 weeks right now. This is a 2 to 3 week forecast. What do we see? Did this gap fill? Yes. There's a gap down. Did it fill? Yes. Now there's a gap up. Has it filled? No. So you're looking at right now, you're looking at the next couple of weeks. What do you see here? Well, you see a target down at 230. You're sitting at 233. We'll zoom into a 5-minute chart. This is a 2 to 3 day outlook on this particular commodity. And what you have is you do have a nice target down here at 230. So building into that short over the next 3 to 5 days is not a bad idea. Short term, right? If you're short term, this makes a lot of sense for you. Let's do USO. But as we walked through USO just now, what do we realize? Well, we realize that there is a ton of selling down at 225, right? And we're sitting at 233 now. Target date. And also, if we look at where it broke out from, there's a target price down there at 174, 180 that will be met at some point. Or if it's not, this is not worth something buying into, not to the long side. Long side meaning buying. You're looking for the price to go up. Target date. What did I say? We're going, well, this right now, sadly is 3 to 5 days. You have to go out 5 days from now. Today's the 5th, so you have the 6th. So you have 9, 10, 11, 12. Yeah, you're looking at the 12th. 9, 12, 20, 24. Get out of here. 9, 12. We'll make it. I mean, it's not going to take that long. Nine, 10. It's got to make it here in 2 days. Well, that's 3 days away. 2 days less than 5 days. So let's go ahead. So now you've walked through gold, right? So what you should know, having done that, what you should be aware of after we have just walked through that, you should see that there should be a downside bias on gold, right? I'm not telling you FOMO can't kick in, that the preppers can't go crazy and say the world's going to end and this thing takes off. But what I can tell you is that you wouldn't want to own it. And if you short right now, you have a good short-term downside target. You can see that there's a ton of selling at 225, which would lead you. That could institution selling there. And a good downside target is 180. But if you're going to play it to the downside, this is where you start. You would start with a price target of 231 over the next 3 days. And then you would reevaluate. That's what a lot of people, they don't realize is that you are consistently reevaluating this stuff. You're never just holding things forever. It doesn't work like that. If you're doing that, you're making a big mistake. You don't hold when you see your opinion can change. Now, if you are swing trading or day trading, you're active in the market. You're at least looking at it each day. Doesn't mean you're doing things every day, but you're at least looking at it each day. So you're aware of these changes. If you're someone who's like, hey, I look at it once a week, I get my setups on Sunday, then you're someone that right now wouldn't be involved in this to any degree unless you were starting to create a longer term downside target of 220. I hope that makes sense. Let's take a look at TLT. This is something that I began buying at 91.80. We did some selling up at 100, and then we did a little bit more buying. But let's go take a look. So here we are at 100. TLT, by the way, if you want to know what your long term on this is, would you call this a substantial amount of trading activity? I'm just curious what you call that. Yeah, clearly you'd call that a substantial amount of trading activity. How far has this particular position fallen? Oh, only 50%. So let me ask you a question. Do institutional traders buy or sell at a low price? What do they do? What is the answer here, everybody? Right. Price has fallen. Price has fallen 50%. So if you are a long-term investor in the market, if you buy and hold, so to speak, this would have been a disastrous buy and hold for you. This would have been, oh, and by the way, it's treasuries, so these are less risky. These are safer. You work with an advisor, this is much safer. It's safe. It's the 20-year treasury. It fell 50%. And right now it's really risky because we're in an interest rate, interest rates are volatile right now. This is risky. This is why you can't speak on typical risk parameters if you're active at all. And if you're not active, you're making a huge mistake. In my opinion, this is the safest asset you could buy right now. There's nothing safer. It was the riskiest asset you could own coming into 2020. It's a 20-year treasury. Risk is relative to the environment that you're working within. Always. Not sometimes, always. All right, I'm going to stop the share there. I've been going for about 40 minutes. I'm going to get into some of those other positions tomorrow. As always, I want to thank you all for joining me. I really appreciate it. I hope you enjoyed it. I hope you learned something. I hope this helped you. That's the goal of these videos. That's why I make them, to help educate you, to help teach you, to help you learn, to see through the eyes of somebody who's been doing this for 25 years. And really, I mean, I just have my intuition with this stuff now far exceeds the need for mechanics, because I've been doing it so long. It's like anything you do for 25 years, it just becomes you and you become it. And so because of that, I have a way that I can explain this to you that makes sense to a human being, because we operate on emotions, and that's how markets operate, not on mechanics. Mechanics are part of the business of the stock market, and those mechanics are used against less knowledgeable hands and retail traders every chance they get. And that's why so many guys make so much money in up markets, and then they lose it all in down markets. They lose it all and then some, or they lose most of the profit, whatever. As always, thank you so much. If you're not good up here, you're not good anywhere. Get outside, see the sun, go for a walk, smile like an idiot for an hour. If you're having a bad day, it will work. Listen, you've never lost. You're still winning every single day. How do I know that? Because you've never failed. How do I know that? Because you're still. Remember, every day above ground is a good